All righty. Hello, everyone. Thank you for joining us today for the MVLS Tax Controversy Training for Attorneys, Law Students, CPAs, and Enrolled Agents webinar. I'm Andrea Foster, and I'm honored to be part of the MSATP Education Committee. The Education Committee works diligently to bring you relevant programs that enhance your practice and help you better serve your clients. This webinar is scheduled from 9 a.m. till 1 p.m. Throughout this session, if you have questions for our speakers, please use the Q&A section. For administrative questions related to MSATP, feel free to ask in the chat section. So the speakers and I will see the Q&A section if you have questions related to the content. To earn full CPE credit for this session, you must answer at least 75% of the polling questions, which will appear on your screen intermittently. There will be 8 polling questions. Please note that you do not need to answer the polling questions correctly to earn credit. Simply participating is sufficient. Now, please welcome our first speaker, John Hart.
Thank you, Andrea. As she said, my name is John Hart. I'm the director of the Low Income Taxpayer Clinic at Maryland Volunteer Lawyer Service. Let me just share my screen here. So we are a Maryland-based nonprofit legal services corporation, the largest in the state by number of cases we take. I believe that's still true. And we work to connect people who need legal representation but can't afford it with volunteers who are willing to help them. And specifically in our tax clinic, of course, we handle tax controversy cases. So this training is for pro bono lawyers, CPAs, or EAs, all of which can volunteer with us, who are interested in taking on tax controversy cases. So we have a lot of social media at MVLS that if you're more interested, you can learn a lot more about us. Feel free to explore any of the links here, as well as our event calendar for more presentations like this. These are just some quick slides about some of the values MVLS holds and how we go about working with our clients. So we're very aware of the race equity context in all of our fields, and we do work in, of course, housing and bankruptcy and criminal expungement all throughout Baltimore. So it's something we want to be very in tune with. But even with the tax system, we want to be aware that tax code appears neutral on its face, but as there's been a lot of scholarly research on, it's not always an equitable result, especially with the pandemic recovery. And you'll see with a lot of our low-income clients, there are obstacles that they face that other taxpayers don't, and it's important to be aware of that. We try to build equitable relationships with our clients and our community partners. It's especially important when dealing with clients who really may have no familiarity with the tax system, with the IRS. I've had many conversations with clients who see it as this terrifying monolith that they just don't understand any of it, and it seems like it's come out of nowhere. And it's important to have a good attitude of working with clients, non-judgmental, trying to see things from their perspective. So I mentioned free trainings. We have more like these. Most of them are not 4 hours. This is one we do once a year that's very all-encompassing. But we also do 1-hour trainings on more specific topics with some of our volunteers and community partners, and not just on tax, as you can see. And of course, I'll talk about this later at the end of the presentation, but I also would really encourage anyone who's even the least bit interested to sign up as a volunteer. When you sign up, you're not going to be drafted into taking a case. How it works is you have the choice of what cases to take and when, based on your own interests, expertise, and time frame. And we will work with you to get the right case placed to you at the right time. And of course, once you take a case, you're not going to just be out on your own. We're happy to help you all throughout the process here at MVLS. So with that introduction quickly out of the way, I'll move on to the main presentation. And starting with, I think, maybe just a quick introduction from each of our presenters.
So my name is Sherry Went-Tazak. I am a solo practitioner based in Annapolis, Maryland, and have well, my practice is primarily tax controversy and estate planning, and I've been involved in some fashion with MVLS for a lot of years. And I don't know, I'll pass it on to Dan or Jay.
Well, I'll go next. My name is Andrew, but I go by Jay Maskus. I'm the current director of the Hearings and Appeals Division, located in the Comptroller's Baltimore office. I've been with the Controller's office for a little bit over 18 years, a variety of roles. Started out in hearings and appeals. I've worked in business tax collections, unclaimed property, business tax audit, as far for assistant director for those groups. And I've also been in charge of writing the business tax guidance for a number of years, and been involved with the MVLS for a number of years, providing trainings on how to represent clients before low-income taxpayers. It's something I'm particularly passionate about. Hearings and Appeals Division not only has the traditional appeals functions, but we've got voluntary disclosure and, most importantly, offering compromise. And so I'm happy to talk about offering compromise because I think it's a great program, both at the federal and the state level.
My name's Dan Heller. I'm a tax attorney. I work at a firm in Columbia, Maryland. I've been doing tax controversy for pretty much my whole legal career. I do civil and criminal controversy, and the types of cases my firm takes are similar to a lot of the things we'll talk about today. I've been working with MVLS really for most of my professional career, and recently, for the last several years, I've been mentoring attorneys who have taken cases with MVLS for pro bono, and I look forward to continuing to do so, and look forward to talking today about the tax controversy.
Great. Thank you, everyone. So to be a little bit more specific about the cases that MVLS takes, our clients are individuals who are below 250% of the federal poverty level, who have an income tax controversy with the IRS or the Maryland Comptroller, in which the amount in controversy does not exceed 50K per tax year. In my career, and I think that probably the existence of our clinic, we've never had to enforce the last part of that requirement, because of course our clients are often very, very low income and they don't typically have tax controversies that are above 50K per year. The definition of a tax controversy is pretty broad, as you will learn in this presentation. It covers a lot of different kinds of disputes, but any kind of dispute between the taxpayer and the government, or specifically a tax collection agency, concerning a tax matter directly financially impacting the taxpayer is considered a tax controversy. We do not do tax preparation. That's the work of a Vitasite. So if somebody hasn't actually learned they owe anything, or they don't think they're going to owe anything, they just need help filing, we refer that to another organization. And we also do not help with acquiring ITINs. Those are the two common pieces of tax legal work that we don't help with. But otherwise, it's probably something we cover. The role of the tax representative is multi-pronged. It has a lot of education, especially, as I mentioned, because many of our clients, they don't really have a lot of familiarity with the tax system. They may not know their rights, and often they don't know their responsibilities when it comes to things like audits, especially. We try to educate them about laws pertaining to their specific case, but often it's also about educating about laws in general, like making estimated tax payments on time. And with every case, we try to bring them into current compliance with collection and filing. But that also depends on the representation agreement and what they came to us asking for help with. But we try to address all of their problems within one case. Is just the most efficient way to do it, and it's the most helpful for our clients, of course. So we often see cases regarding audits, appeals, sometimes U.S. tax court litigation, lots of collection cases, sometimes audit reconsiderations, many non-filers, the occasional instant spouse relief, many claims for refunds. Unfortunately, a lot of ID theft, which is tough to deal with, but we can help in a tax context, and more, and a lot more niche cases. And Jay, do you want to take over this slide?
Absolutely. Let's see. Oh, it looks like there's a poll that just came up. That's nice. All right. Maryland state tax controversy cases. These are the short list of the cases that I think we most see in appeals and that you may also see as representing low-income taxpayers before the Comptroller's Office. The Comptroller's Office has a robust federal matching program through our compliance division and our individual income tax audit group in the Baltimore office. So if there's an adjustment at the federal level by the IRS, it will flow through and down to the Comptroller's Office. We have a again, robust federal matching program, exchanging information between the IRS and the Comptroller's Office on a frequent basis. And so you'll see a lot of your CP 2000s, your federal adjusted gross income matches, your RAR reports for the IRS, that they will be sent to the Comptroller's Office and the taxpayer's account will be adjusted accordingly. We also have a lot of computer matching programs for income tax line items, such as I don't know, errors on the return or W-2s withholdings off if there's been a mistake on a return or it doesn't match our computer records. Of taxpayers an account can be adjusted for that. And non-filer cases, or what is referred to at the IRS level as substitute for return assessments, we're very robust in that program as well, matching up. Did a taxpayer file a federal income tax return with a Maryland address? If so, why is there not a Maryland income tax return? Has a W-2 or 1099 been issued to a taxpayer with a Maryland address? Is there a return? If not, there will be an inquiry, and if the inquiry is not responded to, then there may be an assessment that's generated out of that. For Revenue and Administration Division, we see a lot of balance due returns, a lot of processing adjustments, whether automatic by the computer system or by manual. Again, does the information on the return match our computer records? Refund denials for statute of limitations, amended return denials for statute of limitations, and of note, for low-income taxpayers, questionable return detection team. And these are, I'd say, three types of buckets. One, absolutely fraudulent returns that are an attempt to take a refund out of the state of Maryland. Number two, high itemized deductions and or Schedule C with high income individuals. And then the third bucket are refundable earned income credit review and programs. So the QRDT team tends to touch a lot of low income taxpayers, and particularly with the refundable earned income credit review program.
Okay. So this is the IRS Bill of Rights. I'm not going to read every single entry, but I will say that I find the IRS Bill of Rights is often a good way to educate taxpayers. I find taxpayers, they're quick to say that the IRS has made a mistake, but they're a lot more hesitant to actually, take a firm stand and actually participate in the process and challenge the IRS on a position that it's taken. It's intimidating. So knowing, that they don't just have rights in sort of a vague sense, but that they actually have specific rights that the IRS must respect, right to be informed, quality service, pay no more than the correct amount of tax. I think it's an important piece of education for taxpayers.
Okay. Turning over to the Maryland Taxpayer Bill of Rights. This is a major area of concern or area for improvement. I like to say area for improvement within the Maryland Comptroller's Office. When I started approximately a little bit over 18 years ago, then Comptroller Peter Francho introduced the Maryland Taxpayer Bill of Rights. And with it's had renewed focus with the opening of our Office of Taxpayer Advocate, and our director of that group, Elena Folks, who comes from the District of Columbia Office of Tax and Revenue. that there's been a significant push to revamp those Maryland Taxpayer of Rights, to expand them, to actually provide some, I guess, want to say meat to the bone on those particular items. And I've had our Elena Folks, our new taxpayer advocate, put this slide in, and this is going to be a I guess a preview of the rollout once it's on our website. And a lot of it mirrors the IRS. And I would used to say that perhaps with the Maryland Taxpayer Bill of Rights that was in the previous iteration, it may not be your best lead on this, but I think that with the revamping of our Taxpayer Bill of Rights, I think there's a lot of items that you can cite in there in your arguments. I will say that one of our panelists, Mr. Heller, actually cited our Maryland Taxpayer Bill of Rights with I guess, an offer in compromise a few years ago, and yeah, he was successful in that. So kudos to you, and kudos to Maryland taxpayers.
So I can talk a little bit about initial client contact and interviews. At MVLS, we ask that when you start representing a client, you both sign an engagement letter and fulfill the appropriate power of attorneys and file those. Just good practice. The engagement letter, it can be important in tax cases, especially. I mean, I think everybody, well, maybe I shouldn't say that, but the importance of an engagement letter is important for all attorneys. But in tax cases specifically, it's often a good idea to make explicit that where the boundaries of a tax controversy case are, because I think especially because MVLS has other programs like bankruptcy and estate planning, sometimes clients can get a little confused as to what aspects of their finances you're helping them with. And this is getting a good engagement letter detailing exactly what you're helping them with is good practice. Make sure there aren't any major misunderstandings. And if there are any misunderstandings, that you've done your due diligence to communicate correctly with the client. Power of attorney for the IRS, that's 2848 or the 8821. And with Maryland, that's the 548. The following slide has some more information on those that I can show for a second. But I think also importantly, when we're talking about the initial interview, you want to really get some good context from the client as to how they view the tax issue and how it originated, how long it's been going on. Make sure you get all of the IRS and comptroller's notices that they have for the tax year's issue. I'd probably just ask them for every document from the IRS and comptroller that they have. All W-2s, 1099s, and other support docs, if they have those. If not, we'll probably go over how to request those from the IRS and the Maryland comptroller. If it's a collections issue, I usually start with, I go in pretty early with the 433 collection information statement. That's also something we'll discuss later. That is a collection statement that is useful for a number of different collection alternatives. And then any other relevant documentation, tax returns, anything they've already submitted, and just the general 3 C's: cause, compliance, and cure. What problem you're addressing, where it came from, and where you're aiming to go during the representation. So this is a slide with some more information on the Form 2848. We don't usually talk in depth about the orange slide because we have during this presentation because we have over 100 slides to get to. So apologize if we skim over some of them. But I believe we'll make these slides available for everybody after the presentation, so you don't have to write down everything that we're showing you here.
Yes, I mean, I guess as a summary for this, Maryland has does not accept the federal form power of attorney as POA forms for Maryland tax purposes, so that you have to use a separate Maryland form. The background and history for this was perception of fraud with power of attorneys throughout the states, and Maryland followed suit along with other states in creating its own instructions and maybe heightened standards for identification of representatives. So I guess in getting to the 100 slides, I think those are the headlines. Separate form, rationale was for fraud, different set of guidelines for that. And I, particularly for representing a business, check the instructions and guidelines for what you need to actually provide, depending on your particular designation. So let's see what we've got next here. Yes, there's the information on how to contact for information on the status of a power of attorney. I think similar to the IRS, if we receive a power of attorney, it'll be entered into notes. I've often seen notes listing 2, 3 power of attorneys on there and what years and what actually forms they're authorized to represent. In hearings and appeals, we've gone from a very, I guess, loose power of attorney standard to making sure that the power of attorneys, I think when I started, we knew every attorney that represented taxpayers in Maryland and said, if you affirm that you represent this taxpayer, it's got to be in a letter. But gone are those days, and we require a power of attorney before hearings and appeals in all matters. And it's also a very sticking point among with our frontline representatives as well.
Jay, before you move to the next slide, we do have a question that I think is related to the comptroller. One of the participants is asking, when a W-2 is not available from the IRS, can we request the actual W-2 from Maryland from a previous year? How far back? I'm assuming this is the transcript. Like when we get the IRS transcript, we can't see the Maryland withholding on it. That's what I'm kind of assuming.
Yes, that's a great question. And this often comes up because if you've got a client that has not filed returns and you're trying to piece together the information to be able to file those returns, the wage and income tax transcript with the IRS, it will show you what the federal wages are and what the federal withholding is for that particular form. However, it won't show you what the state withholding is on that W-2 or 1099. In order to obtain that information, you've got to contact the controller's office, and we've got screens called the W-2SP or W-2SC, which will show you the wages, both federal, Maryland, and also the federal and Maryland withholding tax on that. And those should be available through our taxpayer service group to be able to obtain those W-2s. Sometimes they'll provide you with that information over the phone. Other times they should be able to provide you with a printout of those W-2s, but more likely than not, it will be available over the phone. So it's a crucial piece to be able to file the state returns as well. And I will say that our taxpayer services, our branch office, they file Maryland income tax returns free of charge to taxpayers. So that's a bit of an interesting, advocacy or piece there. It typically has current plus 6 years preceding as far as the W-2s. So going back that far, that's typically, but I have seen longer and I have seen shorter. 1980s COBOL programming generally fits within that, sometimes a little bit longer, sometimes a little bit shorter.
So just some general notes on contacting the IRS and the comptroller. You saw on the previous slide, which I'll show again, you have multiple avenues to contact the IRS and the Maryland comptroller, of course. My experience, the comptroller is a little easier to get a hold of than somebody useful at the IRS, so take that as you will. But best practices, always be polite, both the IRS and the comptroller. Take note of conversations. Hopefully this isn't too much of an issue, but I know it's obviously can be a little bit frustrating when you've waited a long time to speak with somebody, but they do take note of everything. Always get the IRS representative's name and ID. This can be very useful if I've heard from a couple of volunteer stories, somebody they got on the phone, the IRS just was not understanding the issue and thought they couldn't talk to them, like even if they had the taxpayer on the phone. Training issues, getting that name and ID can really help if there's some sort of issue to sort out on their phone and you don't want to have to wait for hours on end. Comptroller's office don't have employee ID numbers, but you can ask for their first names. And then writing, you want to include key case info on all your pages. Make sure documents are sent certified with a return receipt. And I would add to this, just try to make it as simple as possible. Both IRS and comptroller employees know the quicker they can understand what's really at issue, the better. So clarity in your writing is very much to be desired.
I second that statement. Given the volume of responses and challenges, I say don't bury the headline. And I generally prefer 1 to 2 page responses with the key argument up front. But so
And a couple of things I would just chime in about making the calls. I mean, especially to the IRS. There's just a few things I've been seeing more recently. So when you contact the IRS, you're going to go through a specific unit. It might be automated collections, it might be calling a number on a notice. Uh, and sometimes you could be on hold for an hour. Sometimes you could get right through to somebody. Uh, Recently, you get bounced around a lot, meaning you could have somebody on the phone. And it's not like you tell somebody what the issue is and they immediately tell you you need to speak with somebody else. If it's your first call for a new client, and maybe with the IRS, you can actually fax a power of attorney to the representative. If it's not previously on file to get the call going, you can't do that with the comptroller. It needs to be filed in advance. But you could be on the phone with somebody at the IRS for 20 plus minutes after waiting 40 minutes for them to tell you that you need to go to some unit that you've never heard of. And they'll send you to that unit, and that unit will send you back to the other unit. And the point I'm trying to make, I guess, is twofold. One, I know be polite sounds easy, and it should be easy, but things can get frustrating very quickly. And you add that to somebody when you're on your third person you're speaking with, and they have an attitude toward you for no reason, that you can seem to understand. You just don't let it get to you. Again, be polite, be cool, and if you really think you're getting the runaround, which you could get the runaround, you can always ask to speak with a supervisor. And that's going to be true of any individual you speak with the IRS, even the comptroller's office. If you find a dispute where either there's a factual or legal dispute that you think you're right and the other side thinks you're wrong, or if you know you're speaking to the right people and they just tell you they can't do anything, either they don't have the training, they can give you any laundry list of reasons why it's not them, you can always request a supervisor call. And that benefits you and the client. One, you're going to elevate to somebody who probably can fix an issue that the lower level representative might not be able to help you with. But two, going back to the scenario where you might be on the phone for an hour plus, it salvages a phone call with a supervisor, or even getting somebody on the phone and more likely getting a call back. It was good time that you spent versus getting transferred to a fourth unit where the call might drop. So just something to keep in mind. And that's just, again, the calls bounce around to the different units. Last couple of years, I just seen that's a more prevalent issue.
I agree with you. I've seen that a lot too.
John, there is a question before you proceed, and I believe you sort of addressed it. But the question is, if the taxpayer is a non-filer, does MVLS prepare the return? So I assume they mean if their notice that they receive is because they did not file a return and one is being forced on them. I guess that's sort of the question.
Yeah, that's a great question, and I don't think I was completely clear earlier. So MVLS does prepare returns, but only when it's to resolve a tax controversy. So in that case, if the taxpayer is a non-filer, they haven't filed for many years, and they do start getting collection notices, if the substitute for return was made, then yes, we can help them prepare those returns and get in filing compliance. If like it's tax season and they just need to file, but they haven't gotten any notices, that's when we send them to a VitaSite, because that's what VitaSites are for. But we do help with tax return preparations if there is a controversy around it. Oh. So I'll talk briefly here about the Taxpayer Advocate Service. An organization, unfortunately, with a bit of an uncertain future, but we as far as we know, we're still using them as an asset to our volunteers, and they are very helpful in certain situations. They are an independent organization within the IRS with the mission to help taxpayers and the system as a whole. They can offer assistance to individuals who experience an economic burden and or a systemic burden due to IRS action. So these are what I'm talking about now are the actual prerequisites to getting assistance from the Taxpayer Advocate Service. So they define an economic burden as significant costs, incurring those, loss of basic necessities, other irreparable economic harm. Most of our clients, if they qualify for our help and they have a tax bill that's kind of substantial, they will meet that economic burden test. Systemic burden, also a common reason why we might call them if an IRS process is not working as intended, or if there's a delay of more than 30 days. That tends to happen a lot. Well, 30 days plus reasonable extensions by the IRS. Unfortunately, sometimes, something is supposed to happen within a couple months, and the IRS says, yeah, we'll get back to you in another couple months. We'll get back to you in another couple months. If that keeps happening, that's a perfect time to contact the Taxpayer Advocate Service. They have their own website that is sort of dedicated both to practitioners and the general public, explaining what they can help with. And it's the Form 911, appropriately enough, that you can fill out to request their assistance. It's a fairly simple form that asks you to describe the issue and explain why you qualify under one of these tests. Even when TAS is working well, there is a delay in getting an actual representative to help you. So keep that in mind. But if this is an issue where the IRS is 6 months late on giving you a response, then it's generally worth it contacting them because it's actually free to everyone.
If I can chime in here, sometimes TAS can resolve things fairly quickly, and sometimes, depending on the situation, it may take quite a while, even through TAS. So, I mean, for example, I have had an innocent spouse case that concerns a complex audit of, the joint return, and numerous places along the way, the IRS did stupid stuff and made errors, and process wise and assessment wise and all that. And I think because of the complexity, TAS is working it, but even they, when I was working the case before TAS, I was getting the runaround like Dan was talking about, trying to get certain things resolved. But even TAS is getting pushback, and they're working it, they're getting there, but it's not always going to be fast, even with TAS.
Mm-hmm. I see we have a Q&A that's actually pretty interesting. The question is, when MVLS prepares a taxpayer's return to resolve a controversy, the return is not signed as a preparer. That's true. How should the return be filed to keep their preparer in the loop and be in compliance with tax law? With me, whenever I've represented a taxpayer, since I'm an attorney, I file a power of attorney, and in that you can specify that you want to be sent copies of every communication sent to the client by the IRS. I think that's what they're asking by keeping their preparer in the loop. There is a bit of a thornier question that, and this hasn't happened while I'm working at MVLS, like if somebody prepares a return and makes a mistake, and then the client comes back to MVLS for help with that, that's sort of a conflict of interest question on the organization's part. So I guess just keeping yourself compliance with Circular 230 as a practitioner be sufficient on your end. I hope I answered that correctly.
All right. Well, for a number of years, and I want to say somewhere between 12 to 15 years, there was an ombudsman office and established by the controller, Peter Francho, to be able to assist taxpayers when they've tried to resolve things through normal channels and they weren't finding any luck in doing that for whatever reason. And the Ombudsman Office, I think I've had various comments with success about it, generally positive. But with the new administration with Comptroller Learman, she wanted to make a push and made a push legislatively to ensure that there is actually an Office of Taxpayer Advocate created by statute, guaranteeing its existence and actually funding it and actually having personnel in that division. For a few years, there was a statute that authorized the Maryland Office of Taxpayer Advocate, but provided no funding for it. So therefore, it was a agency in name only. And I'm pleased to report that not only has it been created, but it's also been funded. And they are actually a director of the Office of Taxpayer Advocate, along with employees within that division to help out taxpayers. And this is modeled after the IRS Taxpayer Advocate Office. And the mission statement, it's an office dedicated to ensuring that taxpayers are treated in a fair and equitable manner. There's the contact information for there. That's just been put up on our website earlier this month. So it's very fresh news. And it offers 4 buckets of help, guidance, and support regarding our policies, procedures, and how to efficiently resolve the problems with the Controller's Office. Hey, I don't know who to turn to. I don't know what the procedures are for doing this thing that I want to do. So they're available for that. Systemic advocacy. This is really important. I've talked with Elena, our taxpayer advocate, about issues that have arisen within the controller's office. There's CPAs on this call. I think you'll know some of those issues that have occurred with our processing, and particularly with certain credits and PTE returns. And systemic advocacy to within the controller's office to try to alleviate some issues with our policies and procedures. Individualized assistance, they do work one-on-one with taxpayers, and then also promoting the Taxpayer Bill of Rights, which has been highlighted on a previous slide. So it is truly a revamped group there, and I've talked with the director every other day about an issue, whether it's individual or systemic issue. And looking forward to seeing the end of the year or end of the fiscal year, a report or some changes about the controller's procedures. So very positive development as a reason.
Okay, so I think now we're starting to get into some of the more detailed steps as to our tax collection cases. I can continue unless somebody is interested in taking over, but this is a roadmap of IRS tax controversy cases, and then the Maryland tax controversy case. Well, not the cases, but maybe somebody should take over.
Yeah,
because
I'll jump into the IRS roadmap. Okay, so basically, this is an IRS roadmap for the types of cases you're going to see from pro bono clients, and so it has to begin with a tax. So that's where you see there's an assessment, and that could be an assessment from an original filed return. It could be a IRS assessment, but the assessment shows a liability. And then come the notice and demand for payment, which is in the form of a slew of letters the taxpayer is going to receive. CP 503, 504 series. As a practitioner, the one thing you want to be aware of on the onset is that the threatening letters taxpayers receive will state that if certain deadlines aren't met, maybe 30 days, the IRS will have the ability to enforce collections through levies, for example, which would be emptying bank accounts, garnishing wages. From a legal standpoint, the IRS can't actually do any of those things until the next step on this roadmap, which is the CDP levy notice. So even though a client might come in saying that I've received this, say it's a CP 504, and it says I have 30 days to pay or the IRS is going to ruin my life, that you might be able to assure the client, and you can by either contacting the IRS to get a status of the account, or we'll just discuss other ways you can determine what's actually happening, but it might not be a real threat. And so when we get to the next segment here, starting on actually the lower portion, so you see CDP levy notice. So the IRS, before they can levy assets, there's a statutory notice called a final notice of intent to levy. And it comes in a few forms, LT11, and there's others, but on the forms, it looks similar to the other threatening notices, but this, it's going to say final notice of intent to levy, but and it should very prominently state right to your collection due process hearing. That collection due process hearing is the key verbiage or language you're looking for. And somewhere else in that letter, it's going to say you have 30 days to file a request for appeals to be able to pursue a collection due process appeal. Now, one thing I've noticed is historically the letters were very clear about that deadline. As of like this year, I've seen, and maybe people may agree or disagree, the first page of some of these notices has a deadline to pay the balance in full, which ends up being, I think, of the date after the collection due process deadline, which is, so page 1 might say you have to pay your balance in full by May 20th to avoid collection action. But then maybe page 2 will say, if you want to appeal this, your deadline to file the CDP appeal is May 19th. That's a pretty significant distinction. And if you file the appeal by the CDP deadline, which usually bold on the letter somewhere, the IRS legally can't do any kind of levy action until the appeal process is complete. And that CDP appeal, it stands for collection due process, you get an administrative appeal. If you don't prevail, you can go to tax court. I guess we'll go down there soon with the trajectory here. But if you miss the deadline, you can still appeal. You get a hearing. It's called an equivalent hearing. But the trade-off there is that you don't have any recourse if your claim is denied in the hearing, and an equivalent hearing doesn't actually prevent collection action. Now, by IRS policy, they typically don't pursue collection action, but that's not a statutory preclusion. So the bottom part is the CDP levy notice. The top of that is the notice of federal tax lien. So when a taxpayer is a liability, the IRS, if it's not resolved in a timely manner, eventually they can file a notice of federal tax lien. That's just a notification. Well, it's not just a notification. It's a notification that a taxpayer is a tax that's recorded with the in the county where the taxpayer resides. And historically, it would go into credit report, which would cause problems for people's credits. That stopped maybe 5 years ago or so. So now the real impact of that is if a taxpayer owns their home and a notice of federal tax lien is filed, in that case, the lien would have to be addressed before the taxpayer is able to sell their home. Now, unlike the CDP levy notice, when you appeal the final notice of intent to levy, you're appealing the threat of levy. For the notice of federal tax lien, you don't get a heads up that a lien is going to be filed. I mean, you get the collection notices, but you don't get a warning that, if you don't appeal, a lien's going to be filed in 20 days. You get the notice of federal tax lien. Once that's filed, you then appeal the filing of the lien, and then you get your collection due process hearing. And that gets us to, so the collection due process hearing for a lien or levy, you can raise any issue you want for the tax periods involved. So for example, if it's 2010 through 2014, which is the CDP period, so either those are the periods covered in the levy notice or the lien, you can discuss collection alternatives, you can challenge the penalties, you can challenge the assessment. Really anything is on the table in a collection due process hearing. And so after the collection due process hearing, you get a notice of determination. If it's favorable, you've resolved the case and the issue, you're done. If your claim is denied, then you get an opportunity to petition the U.S. tax court. This would be a situation where, and there's different standards of review, but if you believe appeals got it wrong on the full law or on the facts, then I would advise that you go to U.S. tax court. And then through U.S. tax court, not that you're necessarily going to have to litigate the case. You could certainly work it out with the IRS Chief Counsel Office, or the case could be remanded back to appeals if chief counsel agrees that, appeals made a mistake that they could fix to remedy the situation, tax court's a good resource. Again, only if a timely filed appeal, not for a equivalent hearing. And then ultimately, I guess, collection actions and collection alternatives, that's the end result for liability. So at any point up to this stage, you were trying to get, it could be an offer in compromise, it could be a payment, and we'll go through these in more details, but a resolution of the tax balance is the effectively the end of the roadmap for the IRS.
Just to tag on to what Dan was saying, which was all excellent. There's a link down here for the taxpayer advocate. There's a PDF. So on the taxpayer advocate's website now, they have like this very complex flow chart of, this, it's a much more elaborate version of what we have here. And with information that you can click through, they also have a PDF. So if anybody wants, it could be a useful resource, especially if you're kind of new to the practice.
All right, thank you both. Before we move on, I see there is an interesting question in the Q&A, I think probably directed towards me. MVLS clients with multiple years corrections filings then have to timely file subsequent current years, but the resolutions are not confirmed, leaving some of the carryover issues that are more easily filed / reported by the volunteer, rather than sending them off to a random volunteer to figure out. So I've continued to file until resolution, in one case 3 years, mostly just one. Is that a violation of the MVLS intent? I want to try to be clear, that is definitely not a violation of MVLS intent that you're continuing to help this person. I also want to be clear that when you set up a representation agreement with the client, you don't have to sort of obligate yourself to be their tax preparer for indefinitely or a certain number of years in the future, if you can actually get them into collection compliance. That is very generous that you're doing that, and I really appreciate it. But for example, if you get somebody an offer in compromise, and part of the offer in with the IRS, and part of the offer in compromise terms is that you have to stay in collections compliance. I think we would expect our volunteers to advise the client on what that means and the responsibility that they have in order to remain in collection compliance. But for example, if you were to say, okay, you need to stay in collection compliance, but your tax situation is relatively simple, and I can refer you to a VitaSite that will do your taxes for free for all the years that you need. Depending on what you have in your representation agreement, of course, unless your representation agreement contradicts that, that would also be acceptable with MVLS cases. Hope that is satisfies the question. Oh, sorry, Jay, were you want to talk about the previous slide?
Oh, yes. I mean, it just because I think it's important to talk about the overall flow with Maryland as opposed to the IRS. Again, if there's a big headline about the difference between the IRS and Maryland appeal flow or case flow, it's that you do not have appeal rights of collection actions with the state of Maryland. In Maryland, there's only 2 things that are appealable: a notice of assessment and a refund denial. So again, 2 things: assessment and refund denial. And that's all we handle in hearings and appeals. So there's no appeal of a notice of tax lien, a offer in compromise denial, payment plan not being set up. There have been some voices of concern about that. Again, I don't think that we do not have the current funding in place for appeals. So given the volume of number of appeals that I have just on tax and substantive issues, there's not the resources to be able to handle that. Could there be resources in the future? Absolutely. But at present, the answer is no. So going along the timeline, return is filed or not filed, an audit or a procedure, you will receive a tax computation notice that will state tax and interest. Please pay within 20 days or bad things will happen. Typically, that will not occur. The 20 days, bad things will happen. Previously, when I first started, in 30 days after the tax computation notice was issued, a notice of assessment was issued with a tax interest and penalty on it, and that gives you your appeal rights. The gap between the date the tax computation notice is issued and the notice of assessment is issued varies, and is certainly longer than more than 30 minutes. Or excuse me, 30 days. Sorry, 30 days is a good better than minutes. So once a notice of assessment is issued, the taxpayer has 30 days to appeal that. Unlike the IRS SNOD, or it's 90 days for that. Maryland is 30 days by statute. If you appeal it timely, you can come into the Hearings and Appeals Division. If you don't appeal it timely, the assessment becomes final and non-appealable, and then it's either it's generally sent to a collection agency to collect upon. If they determine that they cannot collect upon that particular tax account, or for whatever reason, they'll send it back to the controller's office. We'll issue a notice of tax lien. There is an opportunity with Hearings and Appeals for a late appeal. Statutorily, it's called an application for a revision of a final assessment, which doesn't exactly roll off the tongue, and for not very plain language. But this is again, I guess a appeal for reconsideration, and we handle a large volume of these in Hearings and Appeals. And from my understanding, it takes a very long time with the IRS. We handle these on a very frequent basis and generally get these going within 60 to 90 days. So that's the timeline. Again, big highlight is Maryland does not have appeal rights for collection actions.
Thank you. So this slide goes over first steps in tax collection cases, which goes back to sort of what we talked about the first steps of interviewing a client. We talked about how to gather relevant information about their finances, where the tax liability came from, and the forms that you may need. At this point, you'll want to consider the direction you want to take the case in. So if you're going to challenge the tax assessment, if you think the tax assessment was improper, consider what avenues you have regarding that, as we just touched on with appeals. You'll want to consider the validity of the collection actions. Does it satisfy due process? Can you challenge any aspects of the collections as it was performed by the IRS? Look at the client's filing compliance. And then, of course, in addition to looking at their finances, determine what collection alternatives they may qualify for. The client preference, which is obviously very important because, especially with MVLS clients, I think it's important to remember that you're working on a certain timeline. A lot of the differences between different collection alternative options that we see are based on how fast it is to get something. So we'll talk a little bit about collection, currently not collectible status, sorry. And there are very large timing differences between that and an offer in compromise. And we'll talk about the specific differences, but now when you're talking about first steps of the client, that is something you want to go over them with to see what timeline works for them.
So I can step in here. Along the lines of, your first information that you want to gather are transcripts. And depending on the urgency of the situation, you may want to make that phone call right off the bat, fax in the power of attorney and request transcripts. Or if you have time, you can submit it through e-services. Or submit it, and then through e-services, if you sign up for that, you can actually pull transcripts yourself. And so kind of be a little bit more stealthy in your data gathering on the front end before you actually make contact with the IRS. But it really depends on the timing of, if there's that urgent notice, that Dan was talking about, where there's a deadline to file, a CDP request or whatever. So in the transcripts the IRS transcripts actually provide a reasonable amount of information. There's 3 basic types. There's an account transcript, which you would pull by the year and the type of tax. And it would be by an individual taxpayer. All of these would be. So if you have a married couple, you know, depending on the scenario, in most instances, if you pull a husband and wife's transcripts, they're going to more or less reflect the same thing, not on the account transcript and the tax return transcript. And it's really a chronology of kind of what's happened for any one tax year and form. So it'll show if the return has been filed, when it was filed, if there was an audit, you know, additional tax assessed, penalty and interest assessed, the taxpayer make payments on that. Did they file a CDP hearing? You know, little like put that there was I can't think off the top of my head what it is, but there'll be something in there to let you know that they filed an appeal of some sort. You know, if anything was abated, if they were in an installment agreement and they defaulted on if they're they filed an offer on compromise. And you know, it's kind of good, I think, personally, to, if you have the luxury of time, to gather that information before you actually make contact with the IRS, so you aren't, so you know, and you know how to you know, approach the IRS in advance. And then there's the wage and income transcript, which goes back the past 10 years, and it gives you basically everything that has been reported to the IRS with regards to income. So it's going to be your wages, it'll be 1099, you know, independent contractor type income. If by chance, you know, your taxpayer, probably not the MVLS clients, but who knows, you know, they might have, you know, some sort of stocks or a retirement plan, or the interest, you know, that's reported that they've paid on their mortgage. So pretty much all types of income that have been reported to the IRS will be on that wage and income transcript. So if you're dealing with an audit, that might be important. If you're dealing with a non-filer, that's you know, useful information to get, so that can help whoever's preparing the return to make sure that they've included all the information. Because sometimes, I think especially with MVLS, or at least some MVLS clients, they might be kind of transient. They've probably lost documents, you know, along the way and whatnot. And so that information can be useful. The wage and income transcript will show how much federal income tax was withheld, but it will not show Maryland income tax that was withheld. So there's that. And then there's a tax return transcript, which is basically a computer generated version of whatever was filed with the IRS. Also, if I can back up on the account transcript, it will show if there's been a couple references to a substitute for a return, which we'll talk a little bit more about. But if the IRS filed a return on behalf of the taxpayer because the taxpayer failed to file their return, it'll show, you'll be able to see that, you know, whether whether an SFR was filed or the taxpayer actually filed the return, and if it was a joint return versus a, you know, married separate, or you know, that sort of thing. So, and again, you can get that information through the e-services portal if you sign up for that service, or the Tax Pro account. So,
and just I guess just to take a step back for a second, because to make sure we're clear about this. So when you have a new client, one thing you might be wondering is, who do I even call to get all of this? Because I know we went through some slides earlier with contact information. So generally, I mean, there's 2 types of cases. If it's an exam case, there should be an IRS number on a notice. It could be a revenue agent, it could be a tax compliance officer, but there should be a direct number to contact about an open examination. That's pretty straightforward as far as who you want to talk to and how that moves forward. For a collections case, which I believe is probably a big bulk of the inventory, it's not gonna be so clear. And so if a new client comes in and they may or may not know exactly what's going on with their tax situation, usually they'll know they owe something. They might have a ballpark of what they owe and when they owe, and they might have some notices. But let's say it's a scenario where you're going to this kind of blindly, meaning you have a power of attorney in hand. It covers a wide range of years, and your client knows or believes they owe $10,000 to the IRS. So best practice, my advice would be, with that limitation, have the POA in hand, fully executed, I would call the practitioner priority service. You call it in and you go through the options to speak with somebody who is an individual taxpayer. And what you want to do is called a compliance check. And a compliance check is basically the IRS going through the health of a taxpayer's account. So they should be able to tell you what periods of balances, if there's unfiled returns. When you have those calls, you can ask the representative, was there a final notice of intent to levy issued? Is there a risk of imminent collection action? They can give you information, but you can't rely on that as far as if you ask, was there a final notice of intent to levy? And they say no, but in fact there was, and there's a deadline in 3 days. The deadline, you're going to have an uphill battle trying to say that somebody at the IRS gave you bad advice on that deadline. So when you speak with somebody at the IRS, anybody, practitioner priority service, new case, and there's balances due, my advice is request the transcripts. And with the power of attorney, you can submit that during the call to gain access. But a hurdle you're going to have with timeliness is without an e-service account, you can get the transcripts. They're just going to mail them to the taxpayer, which could be a 2-week plus delay. So that is something that if you plan on doing, I think, multiple of the our tax controversy cases, my advice would be to set up the e-services account sooner rather than later. And just along that same vein, so if it's a practitioner priority service case, you want to ask if the case is in collections, meaning is the balance at the point where the IRS has transferred it to automated collections to try to collect the debt? If the answer is yes, then practitioner priority service can give you information, but they can't do anything to stop the collection action. So at that point, you want to ask them to transfer you to collections. You'll go through the whole routine again about who you are, who your client is. But you can cut through some red tape and just say, I was told this case is in collections. If you need to get more information, you can do it. But if you have all the information you need, really all you want to do in that call is ask for a collection hold. And any call you end with the IRS, if there's any kind of risk of collection, if there's a balance due, you want to plan moving forward. So that plan is generally, if it's early on, you need 30, 60 days to update a financial statement, figure everything out, review the file, and recontact the IRS. And they should initially be okay giving you collection holds. But that's a very important thing, because if you talk to the IRS for a long time, you get good information and you think you have a plan lined up, but you didn't articulate your request for a collection hold and it wasn't granted, you could think that you've got a timeline to do something, then find out 2 weeks later your client was levied. So you definitely want to make sure that any call ends with a plan moving forward, and that could either be with their a deadline to follow up with the IRS to do something. So there's a little side note, but the transcripts are all part of that process early on, because those will give you the information you need to make decisions about what to do with the case.
To tag on to that, if the case, depending on where it is in the process, is actually has been referred to a revenue officer, a revenue agent, you would want to contact that revenue officer, revenue agent, and talk to them instead of the collections group in the IRS. So then you have a point person, which is actually in some regards kind of nice when you have that point person. But that also means it's a little bit farther down and it's a more serious situation. And there might be like the hard deadlines. Not that there wouldn't be earlier, but. Yeah.
Okay, well, I think we're hitting 10 o'clock, so why don't we take a 5-minute break?
Okay, I didn't know if Jay wanted to talk to about the Maryland side of.
Are needed to be successful.
I think I've covered that on a previous slide.
Got it.
That
Okay.
a lot of our information is available from the Taxpayer Services group. And I think on that slide, it said it went back 8 years, so maybe current +6, somewhere in that particular range. We'll have a particular programmed date and cutoff.
Okay, sure. Well, yeah, thank you, everyone. Let's do 10:08 after a quick break. Okay, well, I think we are back. So this slide goes over tax assessment and the various ways taxes are assessed on the clients. So filed tax returns are, of course, sort of self-assessment. I guess I don't really need to explain the concept of tax return, but they must be honest and reasonable attempt to satisfy the tax law requirements. They are executed under penalty of perjury. And the other forms of assessment you will see are math errors. These are typically automatic under IRC 6213B1. Also see examinations. These are typically for deficiency assessments. Exams, audits are pretty common ways that we see our clients having credits denied, head of household status denied. Unfortunately, a lot of clients will receive an audit letter and not really respond to it timely. It's a pretty common problem with MVS clients, either because they aren't familiar with the system or they're not really clear on what the IRS is actually asking them to do. Usually, and I think the most common thing they will ask our clients to do is send in evidence that, for example, a dependent that they're claiming actually lived with them for a year, or that they satisfied the residency requirement for either being claimed at all or for certain credits. If they come to us while the audit is still ongoing, we can help them satisfy those requirements. But we usually we find clients who did not respond to the audit well and unfortunately had credits and other statuses denied. A substitute for return, the name is kind of self-explanatory, but if a taxpayer does not file a return for a year in which they are required to, the IRS or the comptroller can execute its own return based on the information that they have. Either from informational returns from the taxpayer's employer or other that's usually why, but from other sources as well. Substitute for return have pretty much the same effect as a return that the taxpayer themselves would have filed, but it importantly does not start statute of limitation on assessment or collections, which is very important to remember. So that collections clock, that statute on the collections clock, which I'm not sure, but it's 10 years for the IRS since a return was filed in order to collect. That does not start at all if the only return file is a substitute for return. And then, of course, I believe we may have mentioned the federal adjustment by the comptroller. If the comptroller gets information that the IRS has corrected a return, we very often will just see a Maryland amount applied as well, based on the same information.
Yep. As I mentioned before, robust matching program, adjustment program by the controller's office. It's almost a guarantee that if your return is adjusted by the IRS, that you will see something later with the comptroller's office.
And I just want to chime in a couple of things. So just, I mean, it's an anecdote, which just as a spoiler alert, I don't really have an ending to it yet, but on the filed tax returns. So normally it is what it is. And I mean, there's things you can do. You can amend a return, you can evaluate if there's worth something, not really be amending it. But we had a client within the last year who had a slew of self-prepared. Well, they've hired some big tax defense controversy company, and they retained them, and it was husband and wife, and a slew of joint tax returns were filed by this third-party controversy company. And so in that case, the returns were filed. I mean, they were signed by our client and her now deceased spouse. But one thing we saw in those returns, they were back several years. They were paper filed returns with digital signatures. And it wasn't a digital signature that you could agree or disagree. The paper returns actually had the digital signature certification on them. So the IRS, like everybody agreed, it was absolutely a digital signature. So in that case, we have a CDPA collection due process appeal, which I'd mentioned. You can raise any issues you really want, mostly in a collection due process appeal. We've disputed the validity of the returns. And the purpose of doing that is that in this case, the returns, while joint returns, the spouse who's deceased, most of his activity was reported on the return. The living spouse, she either was minimally employed or unemployed for the years we're disputing. So the IRS, should the original returns be overturned, she would file correct married filing separate original returns, which have no liability. Now, in this case, it's still an open appeal. There was other periods where we're not disputing the returns, and innocent spouse relief looks like it's going to be granted. So that's why this story probably won't have an ending where I tell you if this was going to be a successful defense. But the point is, you want to look over. I mean, it's easy to say they're filed returns moving on, but there could be something there that if you have a legal or factual argument, it might be worth it. The other thing, and I'll let Sherry chime in if she agrees or disagrees. A substitute for returns, I mean, for a 1040 income tax return prepared by the IRS, those tend to expire after 10 years. So I don't know if she's seen otherwise, but for our clients, I mean, I think we've had a few this year even who have had unfiled returns and the 10 years have come and gone, and whether or not, I think there's some legal authority that goes a little bit more in depth than the just the part of the statute here. But typically I would expect for a 1040 that the IRS, the balance expires in that 10-year window. But I guess,
Sorry.
No, go ahead, please. It's
No, I was just gonna say I've experienced that as well. It's interesting because, like, you know, the code says otherwise, but practically, yes, I have had the same experience you have had, where even with an SFR after the 10 years it goes away. The other thing that I would say about SFRs as well is that you would want, if you have a client who did not file a return and there was an SFR prepared, that you want to talk to them about whether they might want to actually file the return, to have the assessment clock start in case that was an issue. But also because the IRS is not going to file, they're going to file a return that is very bare bones and doesn't have the additional credits and whatnot that might apply to your taxpayer. So, you know, it may not be the most favorable return for them. And it could be that if they filed a return, maybe they end up with not owing or owing less, or, again, depending on the timing, maybe getting a refund. So that would be something to discuss with your clients as well. From a statute of limitations standpoint, on assessment, this is the general rules here. Generally 3 years from the date of the return that the return was filed, the IRS has, and the comptroller as well, 3 years to review and, question, examine, audit that return and potentially assess tax. But then there are certain things that extend that period. So, 6 years if there's a substantial omission of income. If there's no time limit in the case of an SFR, or if the IRS determines that there was a false or fraudulent return filed, willful attempt to evade tax. And then sometimes you'll see in the examination process that the IRS will request that the taxpayer extend that assessment statute of limitations, and there's an agreement that they have to sign. Taxpayer doesn't have to. There's lots of factors to consider, but that might be something that you see as well.
Yep, for the state of Maryland, it's generally 3 years from the date of the filing of the due date of the return. There's no limit to file if there's a false return, willful evasion of tax, or the failure to file or report the IRS adjustments. And the controller generally follows the IRS on this particular assessment with their statute there. And it's a 30-day time to file a timely appeal. Anything beyond that is late, as I mentioned earlier.
Okay, so these slides, I mean, this is just when you have issues about the validity of an assessment. So the taxpayer, the statute has to receive notice of the assessment within 60 days of the assessment. I mean, the big thing to keep in mind for assessment notices for the IRS, I mean, the comptroller too, it's just your appeal deadlines. So for an IRS assessment, and it gets a little complicated. So if the IRS audits a taxpayer, ultimately a notice of deficiency is the final filing that you get tax court rights for. And what can happen sometimes is you can file an administrative appeal disputing in the IRS. Okay, so another caveat. So the IRS with assessments, you dispute and appeal a proposed assessment, meaning that you get notices saying if you don't appeal, if you don't go to tax court, wherever you are in the process, if you don't take action, it's going to be a final assessment. If you take action, it's not a final assessment until the process is complete, be it through appeals, tax court, or what have you. Comptroller, it's notice of assessment, then you're disputing, not after the, I mean, just, it's an assessment, it's not proposed. Jay can speak more about that, but from the IRS, the most, I guess, technical part about this process, the notices are very clear with deadlines. There could be a 30-day appeal deadline. It could say 90 days to petition tax court. But it gets a little technical where, so a taxpayer always has a right for an administrative appeal of an assessment. Meaning that the IRS is eventually, you'll go through the process. Maybe the taxpayer didn't cooperate, maybe they did, maybe you're on late, whatever. But at some point, they're going to say, here's a letter and you have 30 days to appeal. And if you don't appeal, you're then going to get a notice of deficiency. So that's fine. You file the notice, you file the administrative appeal that could hold the notice of deficiency off. And then eventually, if you resolve the case in appeals, you never get the notice of deficiency. You don't have to worry about tax court. That's fine. But from an IRS perspective, going back to that 3-year assessment statute of limitations, usually when you're at that last year to make an assessment, the examination, their directive is pretty much there's no time for an appeal, just issuing the notice of deficiency, because it takes time. I mean, the examiner has to complete their report. That report is then sent to somebody else to prepare a notice of deficiency. That has to make sure it's good. That has to get back to the taxpayer. The taxpayer has 90 days to appeal, and all that has to happen before the 3-year statute is up. So when you're getting close to that 3-year window, a lot of times the examiner is just going to say, look, you don't have time to appeal. I'm going to issue the notice of deficiency. You can file the appeal if you want, but the 90-day window in the notice of deficiency still requires a tax court petition. So usually in those cases, what ends up happening is you skip the administrative appeal, you petition tax court if that's your intention. The tax court case, you file a petition, the government answers, but before you really get into the merits of the case with counsel, with court deadlines, with any of that court procedural matters, you still get a pre-trial appeal. So the case then, even though you have a docketed tax court case, you still get an appeal hearing. And I mean, our experience is you can prevail in those just as well as you would an appeal prior to notice of deficiency. But what the key takeaway there is, if you're hard set on an appeal, once that notice of deficiency is issued, it doesn't matter anymore. Now your deadline is 90 days to file the petition for the notice of deficiency. So just keep track of the notices. And the notice of deficiency is very clear. It will tell you no other action you're going to take is going to change that 90-day deadline. If you're going to continue to dispute it, it's the tax court petition.
And staff.
For Maryland, the tax computation notice is really like the proposed assessment. The assessment notice, it's not proposed. It is. You have to appeal that. The notice of income tax assessment must only be sent to the last known address, which we do not resend notices of assessment absent very special circumstances. And the last known address requirement, it can affect low-income taxpayers negatively because we've seen people that have filed an appeal and then moved 2 or 3 times since they filed the appeal. And so being able to get information updated to the updated address has been proved a challenges. The Maryland MVA notices, we send those 6 months before your license is proposed to expire. So we give people 6-month notice that, hey, we're gonna have an MVA holder, a driver's license holder, a tag and title hold. And so it's 6 months, and it's important to start that process out at the beginning rather than wait for the last week or even while you're at the MVA and then trying to renew things. So those are my tips and items on the Maryland notices.
That said, with regards to the MVA notices, you probably will get clients who come to you like a week before their license is expiring and, you know, please help. And, you know, I guess you do what you can to move fast, and usually it's going to require putting some sort of down payment on if you're going to try and get them into one of the collection alternatives that Jay will talk about later that take time. It's going to be a little bit harder, but while they have 6 months, frequently they just wait till the last minute.
Yeah, time is an asset on those MVA holds. It truly is. The more time that you have to work with our collections department, the better. And you know, I have had taxpayers that have had their license suspended and said, "I'll drive down with a down payment to clear this." And I said, "I wouldn't drive if I were you, but please, you know, the payment is appreciated. Maybe find another alternate means of transport to drop it off."
Okay, so this next slide is just a very basic checklist of the 3 elements of a valid collection action: notice, timeliness, and the method. Notice, ensuring that the client, well, has received notice, they've been told that this collection is going forward. This can be kind of tough to challenge with MVLS clients, especially with mail notices. We often sometimes have trouble with people changing addresses or not changing their mail, or, you know, not updating their mail addresses. If they're you know, in a housing unstable population, can be a little tough to challenge that notice requirement, but it is, in some cases, it can be important. Timeliness, checking that the statute of limitations hasn't run for the collection action, is always important. Sorry if I'm repeating myself, but they are all three of these important. And then the method of the collection action, ensuring that the IRS actually has the right to collect it in this method, whether it be a lien or a levy or a garnishment.
So the IRS will start out with an initial request for payment. It's just, you know, hey, you owe this money, you know, please send us the payment. Sent within 60 days of assessment. And we use the term or phrase like the basically it's a notice and demand for payment. And that actually starts the clock for when the IRS can impose a lien. And so there are secret liens. I don't think we're going too much in detail on liens later in the presentation, but there are 2 types of liens. There's a notice of federal tax lien that has been discussed already, but there's also a secret lien which comes into play, you know, within 10 days after the notice and demand has gone out and the taxpayer hasn't paid. So that's something to keep in mind when talking to your clients and they're asking about liens being in place. But if that taxpayer then doesn't make that payment, then the IRS will send a progression of notices that become a bit more grumpy. So, you know, we have the CP14, which is followed a few weeks later with a CP501, you know, says you have to pay your balance right away, followed by the CP503, again, kind of trying to get you to pay right away. And then the CP504, which is, the final balance due reminder and gives at this point they're giving you the warning that if you don't do anything, we're gonna levy. That one looks really scary, but the levy doesn't actually take place at that point. It takes place after the next one, which is that LT11 or letter 1058. And that one, it specifically will state that you have the collection due process rights to a hearing that, has been discussed, earlier. You definitely need to, obviously you want to get with your client and discuss, how they want to move forward, the details of which we'll get into a little bit later, and try and address these as soon as possible so you don't get to that stage. But just know that the IRS won't levy until that notice that actually specifies the collection due process right to a hearing in it.
So this is pretty important with the statute of limitations for collections. And my advice would be for new cases, when you're going through the balances, assuming it's a collections case, you want to know these dates before you make any decisions about how to resolve the debt. And so basically, the IRS has 10 years from the date of any assessment to try to collect the balance owed. So if you file your client files a 2014 1040 in April of 2015 and no actions taken on the account by the client or the IRS by April 15th, 2025, the IRS writes off the balance. And it's on the transcript if that happens. I think it says written off balance due, and you'll see it's zeroed out. So in the onset, when you see a client if somebody comes into you and they have balances in 2022 and 2023, it's really not that relevant. You don't need to know the specific dates at that point because it's going to be close to 10 years. But if you have a client who has a balance that is 13 years old, my first question would be, well, when does it expire? And so you can get that information in a couple of ways. It's not as straightforward. I mean, I mentioned your starting off point is 10 years from the date of assessment. And you can get that from the transcripts, you can get that from the IRS. But you can ask the IRS when you call, what's the statute of limitation with the collection statute expiration date? I would say I've had a couple of times where the IRS didn't know what that was, which is just a symptom of some representatives have different training than others, but more times than not, you'll get someone with an answer. And I would say probably 90% of that time, you can rely on that answer. But what you want to do is if you have a case where you believe that there might be a imminent collection statute expiration deadline, and I'd say imminent within the next year or two, you want to get the account transcripts. And the account transcripts, when you see them, it's going to walk through per year all of the activities, starting with the assessment and then anything that happened between the assessment and the day of the transcript. Now, if you look at the transcript, it's not going to tell you what the expiration date is. It's not going to tell you what the tolling events are, and it's not going to tell you how to do the analysis. So again, this is where the lawyering comes in, or the any kind of tax professional. You want to take a look, and you need to know, and looking at the manual is going to help you do this. You need to understand what tolling events are going to extend the statute of limitations. So, for example, some popular tolling events or common tolling events would be a pending installment agreement. So when you request for a client that their account is placed in an installment agreement, once it's in an installment agreement, the 10-year clock is running. But when you make that formal request on the day of the request, it's in pending installment agreement status until the IRS makes a decision. So where you can really get jammed up is if let's say there's 3 months left on the statute of limitations and you weren't aware of that. You call the IRS and ask for, I don't know, $100 a month for an installment agreement. If it takes the IRS 8 months to rule on that or make a decision, you've just extended the statute of limitations for 8 months. So at that point, knowing that you might have an imminent deadline, you want to be a little more strategic on how you deal with the debt. But when you're looking at the transcripts, if that was done previously, you're going to see pending installment agreement. And then eventually, it's either going to say installment agreement rejected or some kind of outcome in the installment agreement. So if there was a pending installment agreement to whatever event, either installment agreement accepted, installment agreement rejected, if that was 3 months, you had 3 months to the 10 years. Other things you're looking for are collection due process appeals, offer and compromise. If your client was audited, you would potentially have 2 running statute of limitations on the initial assessment and the audit assessment. But depending on how complicated the transcript is, it could be very straightforward, or there could be a lot of activity you need to sift through. But again, if you have a client come to you where there's maybe a year before their balances expire, you need to know that information to discuss the collection alternatives we'll go through later. So that's something I'd recommend on the front end of a case, going through that analysis for balances. Like I said, I wouldn't get too hung up on the recent balances because you're going to have close to 10 years, but anything where there's a chance that you could have a 10-year statute in play, you want to hash that out before determining, how to resolve the debt.
Yeah, I think going over to the Maryland side, generally statute of limitations or collection issues have not come up, pro taxpayer often. I have seen some of our collection action statutes miss, but it's been rare. For Maryland, we used to have 7 years from the date of the tax assessment. It was recently, and I would say about 5 years ago, extended to 10 years from the date of assessment. But if a notice of tax lien is filed by the controller's office, and it typically is, the collection statute is extended to 20 years from the date of assessment. So it goes from 10 to 20 by filing a notice of tax lien. And again, we were pretty robust in our notice of tax lien filing department for collections. And there's no tolling of that like the IRS. It is what it is from the date that an assessment is issued to either 10 or 20. No action by filing an appeal or an offer in compromise doesn't toll the statute. I have seen a lot of I guess assessments or balance due that are 20 years old. If you have a client that has one of those liabilities that's in that time frame, I definitely would look to see what the date of the assessment was, and whether it maybe collection action may be invalid because of that. So Dan brought up a very good point that the IRS, the collection action or assessment just goes right off of the docket. In Maryland, you actually have to proactively contact our collections department to have a notice of tax lien removed. It's not automatically released once the 20 years from the date of assessment hits. And that's a really good point. And I think I'll put those 2 bullet points on our slides for next year. So yeah, thanks for Dan for bringing that up in an interesting comparison by what you need to do with the Maryland versus IRS. So do a little better next year.
So as to the methods the comptroller and the IRS can actually use to collect from a client against their wishes, they have quite a toolkit. So there's the refund offset. That's where, a refund from 1 year, if the taxpayer has an outstanding balance, it is then applied to the outstanding balance. This can happen on the federal or state level. I believe it can also happen to a federal refund, can be offset to a state tax debt as well. We talked a little bit about liens, secret and not so secret, and I think we will talk about them again. We're talking about most of these again, so I won't go into great detail on just this slide. But there are liens and levies on wages or garnishment, which is what clients usually call it. Bank levies, seizure and sale of assets. Thankfully, not very common for MVLS clients. Usually their largest asset is the home that they live in, which the IRS does not seize as a matter of policy. The MVA and professional license hold, that is a very common method of collection that our clients come to us with, as Sherry said, often as sort of a very stark wake-up call to them that they need to get this taken care of. The passport program, less common to see with our clients, but also quite a serious collection issue if the client is expected to travel abroad or has family abroad and needs to travel for some capacity. And then, of course, the IRS, but not Maryland, can levy Social Security payments to an extent. Not the entire payment. I think it's 15%, might be closer to 20. And then the collection alternatives, which I believe we have further slides on all of these. The extension to pay, which I believe Dan mentioned, is where you actually just ask the IRS for an extension to pay for a certain amount of time. These are pretty easy to request, but again, they're typically not for longer than 30 or maybe 60 days. An installment agreement, I think people are generally familiar with. If you want lower terms on installment agreement, you may need to complete a 433. The partial pay installment agreement, which has implications for the statute of limitations. Currently not collectible status and hardship status, which currently not collectible is the federal, and then hardship status is a catch-all term for the Maryland programs that I believe Jay will talk about. And then, of course, we have the offer and compromise program, innocent spouse relief, and then filing an amended return.
Did you want to discuss these slides, John?
I believe this one, yes. This one is sort of half shaded orange, so it did catch me off guard. But why don't we talk about this one again?
Okay, well, I mean, I mentioned before there are two types of liens. There's the statutory secret lien that comes up, 10 days after the notice and demand. And so, most taxpayers wouldn't know that exists, but it does. And then there's the notice of federal tax lien, which is where, then as Dan was discussing earlier in the process, they will file the lien and then they will give you notice of it and you can appeal it and go through the CDP hearing process to get that removed. Usually that will involve some sort of collection alternative, like an offer and compromise or, paying off the liability or it varies depending on the nature of the collection alternative, but usually that involves addressing the outstanding balance before you can get the notice of federal tax lien removed. And as it says here, it should be filed in the jurisdiction where the taxpayer resides and anywhere where they have real property. So if the IRS files it in an incorrect jurisdiction, it's not really effective against the taxpayer. This is the IRS's way of perfecting its lien against, real property and other property as well, and kind of establishes that priority with the creditors. It attaches to, in Maryland, we have tenancy by the entirety property ownership among married spouses. And so that lien will attach to the property, even if the debt is only owed by the one spouse. This letter here is the letter that will be sent that notifies the taxpayer of the lien and their right to a hearing. And then there's forms that can be filled out to request the withdrawal. Sometimes if you, let's say there is a lien filed and you need to sell your house, you can request basically withdrawal of the lien as relates to that, or discharge of the lien as to that particular asset for the purpose of selling the property. And you have to, on the form, it asks you like whether you're expecting, basically the IRS wants to have, they want to get their take on your proceeds, if there's going to be any proceeds as a result of the sale of the property. And so there's some information you have to provide there. So it doesn't necessarily mean if there is a notice of lien filed on the house, it doesn't fully prevent you from necessarily selling your property, but you do have to interact with the IRS and have that dialogue and sort out what the IRS, paying them that portion of the proceeds that are relevant.
And just, on that same, so if you do have tenants by the entirety property, the IRS, if you have one owing spouse, the lien does attach to that. And the IRS, there's case law where if it got really bad, the IRS could even foreclose with a non-liable spouse. It's not common, but if that lien attaches to the liable spouse, the non-liable spouse still has equity in the property, meaning, like Sherry said, if you're trying to get a discharge of the property and the IRS is requiring a payment of your equity, or the owing taxpayer's equity to release the lien, then it's going to be typically half of the equity in the property and overall. So the non-liable spouse, if the property is going to be sold to satisfy part of the owing spouse's debt, there's some computations you could do where the non-liable spouse arguably would be able to walk away from the sale with some profit. The other thing I just wanted to mention, and this is really piggybacking off what Jay said, off what I said, not to overly complicate things. So the IRS, when your balance expires, if at 10 years the expiration date hits, that is automatic, and that will happen. For liens, though, so if you pay your balance in full, the liens are considered self-releasing, meaning that you took action, you paid it through a payment plan, a lump sum, an offer in compromise. Once the IRS receives and processes that payment, it might take 2-3 months, but the liens will be released. If your balance or your client's balance is resolved because the balance expired through the 10-year or whatever statute of limitations for the CSED, you do need to contact the IRS lien unit to request that the liens are released. It's not automatic. I mean, they'll do it, and they're not going to push back. And it's at that point, they'll take care of everything. But if you don't make that call to the lien unit, your client could wonder why they still have liens against them months or years after a balance had expired. So that's just more of a practice point. Again, it's a quick phone call, but something that does need to be addressed for cases that are collection statute expiration cases.
Absolutely. So these following slides are the secondary slides, so we won't go over them in great detail, but there's some more information here for people about liens and sort of how those interact with other, liens and mortgages and withdrawal forms. These are also levies. I think we shaded these as secondary as well, but they actually, why don't we just talk about this very briefly, don't we? So a levy is a legal seizure of property or rights to property to satisfy a debt. If the tax is properly assessed and not paid within 10 days of the notice and demand, the IRS has the power to levy. Tenure from assessment, of course. And collection period as agreed between taxpayer and writing time. Okay, that's if there's another agreement between the taxpayers.
Yeah, so I mean, levies generally, just this is where, if you contact the IRS before levy action occurs, like I said, the goal is to, every time you communicate with the IRS, to have a collection hold moving forward. And if you have deadlines with the IRS, typically for a collections case, there's going to be deadlines to continue negotiations. And that could be starting with call-ups back in 30 days or 60 days with a financial statement and a proposal. It gets technical, but once you go through the process of the financial statement with the IRS, which we'll go into more detail, either you work something out on that call or you're pending a resolution, or the IRS needs more information and you set another follow-up date. So as long as there's follow-up dates in the system, eventually you'll reach an endpoint, which is typically the resolution. So if the resolution is currently not collectible status or an installment agreement, then while you're in those situations or statuses, the IRS won't issue any levies. Now, the tricky part is, what happens if the IRS issues a levy before you get, or a client, maybe a new client, says, yeah, I got a bank levy last week, or I'm coming in now, I want to resolve this, but my wages are being garnished. So there, for the bank levy, typically the IRS, from the day of the levy, has to hold it for 21 days before the funds are released. And so typically that bank levy, the day the bank processes that levy, it freezes the funds in the account on that moment in time. So if the bank had $1,000 in it when the IRS or the bank received the levy, $1,000 is frozen for 21 days. Taxpayer then puts more money into the account. That account shouldn't be restricted. But to get a levy released, it's really, I'd say, it's the simplest, one of 3 ways. Either there was a legal issue with the levy, and then you can dispute it on that front. And I would say it's probably the least likely, but it's possible that there's an argument there. You could argue hardship, which is probably what you're going to end up doing. And to do a hardship, again, we'll go through the financials, but it's either dealing with a revenue officer or automatic collect, whoever issued the levy. if you can prove to the IRS that that levy, be it through wages, be it through assets, it's going to cause your client a hardship. The IRS they should release the levy. And to do that, again, we'll go into the financial statement, how to prove that, but that's something that could happen. The last scenario would really just be advocacy. And there's no science to it. If it's a new client and they came in saying, the IRS is garnishing their wages or attached something, my advice would be call the IRS, call who issued the levy as soon as you can, and try to see if you can get the levy released by just, if nothing else, an agreement moving forward. And that could be a coin flip, but it's definitely worth it to say, it's a new client. Here's their situation. I don't have the financials yet because they retained me 2 days ago. But here's generally what's going on with their life. And if all the money they own is in that bank account, and if that bank account fund isn't released immediately, they're not going to be able to eat. Or this is the first time this has happened to them. They have a wage garnishment. Their kids need to get clothes. If you speak with somebody at the IRS and it's a compelling enough argument and you have a plan moving forward, which could even be like, set a deadline for 2 weeks, like at the financial statement in a proposal, you push the issue hard enough, you can get the release without documents in hand, but that's really if there's a rush. I mean, ideally have a financial statement in hand, be ready to go through that, but you just don't always get that luxury depending on, more times than not, client contact and where you start the, in the process.
Yeah, absolutely. So we have some more secondary slides here. I will call attention, at least on this slide, definitely, on when levy is not allowed. At the last bullet point there, Vinatieri versus Commissioner, there is actual case law to, as Dan was saying, making that advocacy argument to the IRS that, the taxpayer, your client, is going to be in hardship if this isn't released. There's also a list here of the many kinds of different income that is generally exempt from levy that the IRS is not permitted to touch that program. Some information on the required notices and the procedure of a levy release more formally. Before we move on, I also want to talk about a question in the Q&A. This is regards to the financial statement for which we are approaching, I believe. How important is keeping current payments of correct withholding in the current year when determining how much disposable income is available to pay taxes assessed from prior years? Many times if the taxpayer is in compliance with current year payments, there's no disposable income available to pay prior years when the 433 is filled out. It's very important. And we'll talk about how current year taxes are actually entered onto the 433, I think, when we actually get to that form. But yeah, current year taxes are a payment your client is legally required to make. So you definitely want to make that clear on the financial statement that, their income is what it is after taxes. And then another question just came in. IA stands for installment agreement. And yes, we will try to make sure that the abbreviations are more clearly defined on the slides from moving forward.
Okay, let's see. This is a Maryland slide. I actually think I've covered this in a previous slide. 10-year date of the assessment, 20 years from after the date of the assessment. Those are your statutory citations, which are helpful for if you have a client that you come across that has a very old notice of tax. And just a few comments on the levy power. The state of Maryland does do bank levies and wage garnishments. Statutorily, we're required to issue a notice of tax lien before any of that happens. So the taxpayer is definitely on notice that something has occurred at the controller's office and they owe a tax liability before we do a bank levy or wage garnishment. Once you have a bank levy or wage garnishment, it is extremely difficult, I would say, to have those funds returned to you. There's not a set statutorily defined return rights for that, for those funds. And generally the collection agency our collection group for the controller's office doesn't want to set up a payment plan when they have a wage garnishment in place. So I would say that as opposed to the IRS, the controller's office has limited rights about returning of funds.
And just one thing I think it's important to note on this slide, Jay might have mentioned it, but it's worth repeating. So the second bullet point, so an assessment may be made at any time if an income tax return is not filed. So this is the same with the IRS. I mean, legally, if you don't file your taxes, there's no statute of limitations for the IRS to make an assessment. But it's the second part of that you want to make sure your clients are aware of. So if a report of federal adjustment is not filed with the comptroller's office, there's no statute of limitations for the comptroller to make that assessment. And in practice, what this ends up meaning is that if you have a client who's audited by the IRS, let's say it was for a 2019 tax return, and that audit results in the IRS assessing a balance for your client's 2019 income tax return. So the IRS is more likely than not going to share that information with the comptroller. And so if your client, you should advise them to be proactive and amend their state tax return to address it, because it could pop up 8 years later. And the comptroller doesn't have a statute of limitations. And if the comptroller assesses it, there's penalties, there's interest. It's going to be a much larger problem that can really blindside a client when it could be taken care of in advance. So, but there is no statute of limitations there. So that's something that for federal audits, just keep, when the outcome, if there's an adjustment, make sure you deal with the state after the fact.
And I've had the question of, how do you file a report of a federal adjustment? And there's two ways. Most often someone files an amended return with the state of Maryland, but there's also an alternate, and that is to email the adjustment report, RAR, to our compliance division, and in particular our compliance programs individual income tax audit group. And if you email that report to that group, they'll go ahead and free service adjust your client's account and issue the tax assessment there. So amended return or following a sending a report to our compliance divisions, compliance programs, or individual income tax audit group.
So to piggyback on all of that, going back to the initial part where we're doing our data gathering, when you first start working with a client and you're contacting the IRS to do your compliance check, even if the taxpayer doesn't think that they have a state of Maryland issue, it might be best to also get a power of attorney filed with the comptroller's office, do a compliance check with the comptroller as well, in part to just make sure that you're covering all bases. And there has been, for whatever reason, I see a trend in taxpayers, while they may receive notices from the IRS with some regularity, sometimes seem to be baffled and surprised that there's a liability that they owe to the comptroller. Sometimes stating, well, frequently in that situation, stating that they never received any notice of it, which I'm sure the comptroller is sending the notices out, but for whatever reason, that seems to be more common than with the IRS, that they're seem to be not receiving notices.
Really no, it's interesting. Okay. All right, statutorily authorized collection actions, as I said, refund, offsets, seizure and sale of assets. The Comptroller's Office is actually authorized to seize and sell assets. I don't think they've heard of an example of this in the 18 plus years that I've been working for the Comptroller's Office. The MBA hold and professional license hold is certainly well known. Again, I put in bold, there are no appeal rights for collection actions under Maryland law.
So we're kind of diving into the next phase of this after we've done all our data gathering, kind of figure out what's going on. We need to help our client figure out how to resolve an outstanding liability that's owed to the comptroller and or the state of Maryland. The main form used for doing that is this collection information statement. The IRS has various versions, the 433A, 433F, which are for individuals, the 433B, which is for businesses, and then the 433A OIC and B OIC, those are for offers and compromises for individuals and businesses. And the state of Maryland has a similar but different version of those 433A and 433B. And, you know, a lot, as you've probably already gathered from our discussion so far, a lot of how we resolve our clients' liabilities is a function of their financial status. And so these are the forms that are used to gather that information and report it to the IRS or the comptroller. And the information is largely a function of, you know, income and expenses and then assets. And so from an income standpoint, you not only want to fill out the form and you know, sometimes I might, usually I end up, sometimes I might give the form to my client and have them fill it out as best as they can. Frequently, they don't fill it out correctly. So more commonly, I ask for documents and then I can prepare it for them. And so you'll want to, you know, give them a good laundry list of documents that they need to provide you, assuming it's relevant to them. You know, paychecks, Social Security, that like annual statement that says how much they're going to be getting for the year and how much being withheld for Medicare and whatnot, unemployment, food stamps, you know, 1099s, whatever they have that shows what their income is. For individuals, they usually are looking for 3 months worth of data. For self-employed individuals, which would include people who are independent contractors, I think, they would oftentimes 6 months is requested. And so then from the bank statement standpoint or expense standpoint, you're looking at, you know, basically stuff that's considered necessary living expenses and or something that's maybe not necessary, but you want to include because you're going to try and get the IRS or the comptroller to accept it. And so at any rate, you know, housing and utilities or mortgage, you know, mortgage statements, utility bills, leases, medical bills, car payments, you know, that, and then find out what assets they have, and you'll want some documentation to kind of substantiate that as well. More and more now, the IRS has updated their 433 forms to include things like cryptocurrency, and there's language in there that discusses that if you're, you know, a YouTuber and are getting income, that's income that you should be reporting and things like that. So just kind of keep that in mind. And then we use that information to process and figure out exactly what their financial situation is, so we can help guide them in how to resolve the outstanding debt. And I had another thought, but it's escaped me right now.
And one thing I just initially that this comes up a lot of times when you have a client who's married and your client has a tax liability, but the spouse doesn't. So there, the assets are pretty straightforward about disclosures and the liabilities. So for assets, anything that is jointly owned, you need to disclose. Now, again, the equity, there's issues with that, but that's later on. But you have to go through joint assets. Assets that your client owns separately need to be disclosed. And that's pretty straightforward. Now, your client's non-liable spouse's assets, his or her separate assets, do not need to be disclosed. The IRS can't collect those assets to satisfy, at least not in Maryland. That's where we're going to be focusing on today. So that's all pretty sure. For income and expenses, it gets a little trickier with clients. So a lot of times your client is just going to say, I don't want to get my spouse involved. I don't want to share any of their information. I don't want to share any of their income, any of their expenses, what have you. So legally, you can limit it to your client, meaning your client's income and your client's share of the household expenses. Where you might see pushback from the IRS is that a situation where if your client, let's say, makes 10% of the household income, but you're only going to know that if you know what the client's spouse is making. So if you present the IRS with a great argument about, let's say, why your client, you present your client's income, and let's say half of the shared household expenses, there is legal authority for that, and you could fight for that and you might prevail. But it's possible the IRS is going to say, well, I know you don't have access to it, but we do. And we know your client's only contributing to 10% of the household income. So we're only going to give your client 10% of the household shared expenses. So the point of this is when you talk to your client initially, and my advice would be, if it is a married household, there's no harm in getting the spouse's income information, the total household information. At least then when you're preparing a financial statement, you have all the details to vet it out. But again, you could get pushback from your client about not wanting to involve their spouse. And that's a decision, you're going to see what kind of information you're ultimately going to get access to proceed.
So tagging on to that, very good point. And I've had clients who do not want to, they just will not proceed because they don't want to share their spouse's information, or in some instances, their spouse doesn't know that there's a liability and they don't want to get them involved because they don't want the spouse to know. But then also there are situations similar but different where like I have a client right now who's recently divorced, and she and her 2 kids had to move in with her parents. So she's paying her parents' money as rent and kind of utilities. How do you substantiate that? And so you can use, you want to look at, you encourage them to do something like write checks, something that's traceable, as well as combine that with like an affidavit from, the parents or whoever, the roommate, whoever that might be, to kind of substantiate those expenses. In those situations where it might not be more, where they don't have a lease necessarily, or a mortgage or whatever.
Okay, so I don't want to cut this discussion in half potentially, but we are due for a break. Do you guys want to maybe discuss the next few slides about reasonable collection potential and then go on break, or that work?
I'm fine either way.
Yeah, I guess because we're probably going to need a good amount of time to get into the nuts and bolts of the 433A. So
Yeah, okay.
I don't think either way. If we stop now and then jump into it, I think that should work too.
Why don't we do that? Yeah. And I will answer one more question from the Q&A before then. It would be nice to have a comprehensive list of documents that practitioners should request to prepare forms 433 for the federal and Maryland tax authorities. As we will be getting into, that it would be a really large list, and it would pretty much, it depends a lot depending on your client. So you see some examples on the screen here about bank statements, mortgage statements, utility bills. If you're putting it on the 433 as an income or an expense, and there's any chance that the IRS will challenge it, you should probably have some sort of documentation but backing it up. And we'll talk a little bit about collection standards too. Certain small expenses below those collection standards you don't necessarily need documentation for, but anything above those the IRS can certainly challenge that.
I agree completely. And like looking at those bank statements is important because you can identify some expenses that, especially if they're sizable in amount, you'll want to have some sort of substantiation or minimally an explanation about. And yeah, looking at it, anything that goes onto the 433 amount wise, you should have some sort of document to substantiate that. Great.
And one thing, the IRS, if you look at this, isn't the catch-all be-all, but one of the forms we'll talk about is the IRS Form 433A OIC. That form in particular is for federal individual offer and compromise financials, but the section 10 of that form, or at the very end of that form, there is a long list of there's a checklist of applicable attachments. So that if you're just looking for a broad net to cast, that's a pretty good general list that the IRS has laid out in that. Again, it's the Form 433A OIC, page 8. And just you'll see it's a checklist of documents you might want to collect for a financial analysis.
Perfect.
So if I can just let me know if it becomes problematic, but the Blue Angels have just started like their practice down here in Annapolis. So they just they pretty much go over my building. So hopefully that won't interfere, but just wanted to give you a warning in case that is a problem.
Okay, sure. Yeah, we didn't hear anything this time, but we'll keep that in mind. All right. And why don't we check back in at 11:15.
Good.
Well, welcome back, everyone. I think we had just finished talking about everything on this slide. So we talked about the basics of the different 433 forms, different kinds of income and expenses that you would list on them. Next slide is talking a little bit more about reasonable collection potential. Essentially the term that the IRS uses to describe how much money it thinks it can realistically collect from a taxpayer to cover their debts. This includes both future income and their net equity in assets. With MVLS clients, that usually includes the value of their home, but it can also include vehicles that they own, other kinds of asset and equity. You can learn more about this in the Internal Revenue Manual, Part 5, collection process, how they calculate this, as well as Tax Topic 202, tax payment options.
This is so conceptually, this is going to be the foundation of the collection alternatives of the IRS. And we'll go through to more details. And that's going to be a big part of what we do today. But just fundamentally, what you're going to see if it's going to be a payment plan or hardship status or an offer in compromise to try to settle the debt, the IRS is really going to want to compare taxpayers' assets to their debts and their income to their expenses. And again, it's much more detailed than that, but fundamentally, those are the four things we're going to be looking at to determine, one, what as a representative, as a practitioner, we would recommend that the client and the taxpayer do to resolve the debt, but two, through negotiations, the type of stuff we're going to be working with. So, but that reasonable collection potential, that concept is going to be pretty prevalent throughout the next several slides. Okay, so here, this is another core concept when you're dealing with the IRS. And this again, right now we're not honing in on if we're talking about whatever collection alternative you want to pursue with your client. So income is pretty straightforward typically. Whatever your client earns, if they're wages, you present the wages, and that should be an agreed issue. I mean, there's always the potential that there's a major change that the IRS is unaware of, maybe unemployment or decrease of employment, but 99% of the time, income is fairly straightforward. So expenses are where you're probably going to focus most of your effort on, collections. And so your client's actual expenses are going to should be pretty clear cut. What they spend on their food, on their housing, on their car, on their whatever. I mean, you can go through and you can inventory every expense, and you could look at a 3-month window and you could do average monthly expenses, and that's one set of information. That's a good jumping off point. But what we're going to go through in pretty great detail in these slides is just because your client incurs an expense for collectability purposes and what the IRS will consider in allowing a collection alternative, the IRS has certain standards that they use in these expenses. And so that means that depending on the expense, could be a ceiling that the IRS will allow or a maximum for certain things based on what the IRS has as national and local standards. National being obviously across the country, but local is limited to really counties throughout every state. And when you see as we go through this, sometimes those standards provide a ceiling that there's always some discretion to go above or below. Sometimes though, they just provide an amount that could be higher than the actual incurred expense, but you don't have to go through the process of trying to calculate it. Which brings us to this slide. So going through the expenses, starting with national standards. And again, at this point now, you're considering a collection alternative, but to determine what your client can pay, the bottom line is you're trying to figure out is what is their net household monthly income after all the expenses are accounted for. So you have food, clothing, and miscellaneous. And so, and I guess this is also just a bigger concept. We haven't touched on it, and so now is as good as time as any. there's a lot of references to the IRM. And if you haven't worked with it, that's the Internal Revenue Manual. The Internal Revenue Manual is basically the IRS employees handbook for how to deal with really any situation in an administrative capacity. And the IRM, it's all available online. You can Google it. All these sections are public information, but when you're working with the IRS to negotiate any kind of collection alternative, you're going to want to be able to cite to the Internal Revenue Manual. And if that's not the law, I mean, it's an employee handbook, but it's what their decision is going to be based on. And if you're in an appeal, that could be what an appeals decision is based on, with the caveat, and this probably wouldn't come up in a collections issue, but I mean, the Internal Revenue Code, and that's a statute, trumps the handbook. But if you go into the IRS to try to negotiate a collection alternative with the Internal Revenue Code and case law lined up, you're not going to get anywhere with an IRS collections representative. They want to see the manual. So as we go through these things on the list of expenses, that's why we cite almost exclusively to the Internal Revenue Manual, because I mean that's the language the IRS speaks when you're making these proposals.
Can I just interject here? I also, kind of on the flip side, sometimes if you're getting pushback from the IRS on something and you don't believe that there's a foundation for that, I will ask them, so can you give me, your reference for that? What is the code or what is the IRM section that you're relying on in making that statement, that's negative towards my taxpayer? Just so they can't just willy-nilly say, make things up.
And then you'll find out that they did make it up, and then you have to live with they'll say it's an internal office policy, it's our unit's policy. That's where I would recommend going to a supervisor when they can't defend what they're saying. But so this is, I mean, some of this is relatively straightforward. So we look at food, clothing, and miscellaneous, and this is one of the things you want to talk to your client when they're compiling information, especially if you're having them take a stab at a financial statement. So if you ask anybody, what do you spend per month on food, clothing, and miscellaneous, and it's a household of 4 or 3 people, you could probably spend an hour trying to figure out your monthly budget, going through our bank statements, credit cards, and that might be great, and that might be fine, but the IRS has a standard. And the standard, usually the IRS doesn't deviate from it. And again, it's available online. We'll have the website in here. It's also consistent with the manual, but the standard 99% of the time is just based on household size on a national scale. That's what you're going to use. So you want to have a sense when you're telling the client if they're going to compile things themselves, just to be aware of where standards exist. And so sometimes, if they know what the standards are going into it, which sometimes the standards are a ceiling, sometimes the standards are a given, it can save your client some headache on the front end for going through a process of, again, for food, clothing, miscellaneous, the standard might be better or equal to what they would have determined and save them the headache of trying to calculate that.
And that standard based on the household size, I just want to comment that the IRS is going to look to, so if you have a single person and they're claiming 3 children, they're going to want to know that that taxpayer is actually claiming those 3 children as dependents on their return. They're not going to be inclined to accept that they're supporting 3 people if they don't actually have, if their ex-spouse is claiming those 3 kids.
And you see issues that one of the issues you'll see there too is when you have a client who has a dependent living in their house, but that dependent maybe has a job. And then you get to issues of the dependent who has an income source. What are they contributing? So this is stuff like this is straightforward with the minor dependent children on the tax return. It's when you get to situations where that's not what you're dealing with that you want to dive deeper into the manual. And these, again, this section here is a jumping off point, but the manual is massive. And as you get more comfortable navigating it, I would say most of the questions you're bumping up against, there's an answer there. So that's just a resource you want to keep in mind. We're going through really any of these things. If you're deviating from, I would say, what the standard is going to be. So food, clothing, miscellaneous, household size, again, national standards. vehicle ownership, also national standard. So it's 1 car per person. And usually for husband and wife, 2 spouses, you're looking at maybe 2 cars for a household. If there are 2 spouses living in a household, if you have a single taxpayer, usually it's going to be 1 car. And here, a lease or a loan, the 622 is really that forms a ceiling. So if your client is paying $400 a month for the vehicle for their loan or lease, uh, that's the amount that should be reported on the 433A. The flip side is your client's paying $700 for their car. It should be capped at 622. The caveat there, and we're going to go through this. So none of this is set in stone, meaning if your clients for pro bono cases probably aren't paying $1,200 a month on a vehicle, but if they're paying $680 a month for a vehicle, I would argue that. So I wouldn't limit myself to the standard. The IRS might limit it to the standard, but I would argue that if my client needs a car to travel, and maybe that car has probably no equity in it, and so if the client needs to pay $680 a month to use that vehicle, I would push back to the IRS to say, so what's the alternative? They can't sell and buy a new car. They don't have the financial wherewithal to do that. So either they pay the $680 or they don't make any money and they can't pay anything back. I'm not gonna say you're gonna win that argument every time, but it's absolutely worth making.
But I also have a discussion with my client and let them know that this is what the standard is. This is what the IRS is, the max. But I will argue that you should be able to claim more.
Yeah, that's me for this whole, and I agree. You have to set expectations.
Yeah.
So people come in here, the clients, and again, it doesn't be everything, but they could say that, their vehicle, or they want to pay their kid's vehicle. And they might not come up again with these cases, or somebody's, they want to pay somebody for their children. There's some expense they're incurring. If it's a legitimate expense and there's an argument to be made, you can make the argument. But again, from a client expectations perspective, you always want to go in there to let them know, we can argue anything in good faith for actually incurred payments, but they should get a sense of the IRS. Here's where we're going to get pushback. And maybe we'll prevail, maybe we won't prevail. But you want to, in your mind, before you get into this, have a sense of the big picture, which we'll get into about, we get actual numbers. Your numbers might show a net income of negative $300 a month with actual expenses. But once we account for the standards, maybe it's a positive 150. And that's the kind of conversation with the client going into it. We're going to argue for hardship, but maybe expect the IRS to want to have a couple $100 a month to resolve your account. We'll get into more specifics, but this is just on the front end, the kind of things you want to think about when you delve into the details.
And it's also that's why it's important to get a full understanding of your client's financial situation and all of the expenses that they're incurring, and making sure that they give you all bank statements, all pages, not just the front page of a bank statement, and not just maybe their checking and savings account, but also their credit card, statements as well. Like, it's really important to make sure that they give you everything. And that's the only way you can really properly advocate for them. So this here is a spreadsheet. It is just to kind of symbolize, it's helpful to have some mechanism. I like Excel and this is something I had used. It's morphed over the years, but to kind of just, have the formulas in there so you plug in your numbers. I have a way to keep references to make sure that I'm tagging with the substantiation that I have. So I know that I have substantiation for it. I also have, you can see there's a column there for the IRS allowed amount, where it says allowed standard 1, and then what the client's actual expenses. So you can have something, like this in front of you when you're having that discussion with the IRS. So you're kind of ready for pushback if necessary, but it also helps you to kind of get all your information and kind of keep it when you're trying to do your data gathering with the client to make sure that you're hitting everything. So if you ask your client for their vehicle expenses, they're probably not going to think about, maybe they think about the gas and the insurance, but they don't think about the, all of the repairs or their registration and stuff like that. Just for example, or, in the housing, maybe they forget, about their cell phone, or, it's just that way. It's something to be used for talking points with your clients as you're gathering all this information.
And I think it's important to go through, I mean, because this is going to be, I mean, this form, and in some capacity, it can be the 433F. So 433F, that's the simple version of the 433A. If you're with automated collections, that's what they've been asking me for the last couple of years. If you're the revenue officer, it's the 433A for an individual. A little more complicated, but same income and expenses. If it's an offer in compromise, Sherry mentioned 433A OIC. Again, similar information, but I would say a table like this is especially helpful, and you'll see it. So if you're dealing with a 433F form, it's not very large, but they don't pull all of the income and expense items together in a clear table like this. So you would, with the form in front of you, the IRS, you're not going to get a clear answer of what your net income is just by looking at that document, because there's things that are included in the income and expense section, then there's things that are folded in other sections. So if you have a version of this table alongside that form with the IRS that match each other, if the IRS gets in a fight with you over certain expenses, you want to be able to play with the spreadsheet to see if your bottom line matches the IRS when you come to an agreement on what's allowable and what's not allowable. But going through just the expenses, so food, clothing, and miscellaneous, there's a standard there. It's a national standard based on household size. Housing utilities, that's a local standard based on household size. And that's based on the county. So you go to the IRS, you can look at the Internal Revenue Manual. There's a website we'll show you that has all these different breakouts, but that'll give you what the IRS ceiling is. Vehicle ownership, we mentioned, that's based on number of vehicles, national. Vehicle operating, that's local and number of vehicles. Public transportation, there's a standard there. And that's also, you have a vehicle and a public transportation expense. You can claim it, but you would have to explain why there's both. Health insurance, so there's no limit on health insurance as an example. The IRS doesn't have a standard for it. If your taxpayer has a monthly insurance premium expense, that can be included if you can prove it. The IRS, I haven't seen them push back on health insurance for your taxpayer and their family.
I've had, oh, I'm sorry.
No,
I've
no.
had in that with regards to health insurance, I've had a client who was self-employed and didn't have health insurance as kids, needed to get health insurance, and he had he got, basically we're saying he's in the process, he knows he needs it, he has these health issues, he needs to get, insurance through the the state, we got quotations basically saying, this is, he applied, so when the enrollment period came open, he could enroll, and so we presented that information for it was for a currently not collectible request, and that was allowed. There was no pushback on that. And then related to that, with regards to the out-of-pocket expenses, the amounts that are listed as the standard are generally, you're given that regardless of whether you pay that or not. But if you have more, out-of-pocket medical expenses than that amount, you're definitely allowed the increased amount, but you need to be able to substantiate it.
Well, should we go back to that slide just real quick, just to finish? Because I just want to go through, I think it's important that so the remaining expenses, so we have life insurance there's no standard for it. I would say if there's a reasonable insurance policy and the expense is, I mean, when I say reasonable, I mean, if you're a taxpayer who has, a $5 million policy, you probably won't see it, and they're paying $5,000 a month for a policy. The IRS would probably consider that excessive. But if you have a family where the life insurance is, a reasonable amount and it's a couple $100s a month or so, the IRS is more inclined to allow life insurance, but it's discretionary. Court order payments, if your client maybe has the child support, or if there's a criminal background with restitution payments, you just want to be able to have proof of those documents, but those expenses should be allowed if they're court ordered. Child dependent care, so that could be a little trickier. A lot of times that has overlap with food, clothing, and miscellaneous. But for example, if your kid or your client's child has to go to daycare so your client can work, even a summer camp, so your client can work during that time, they need to be out of the house to do that. That would be, should be an allowable child dependent care expense, and granted a reasonable amount. You just need to prove the amount of the expense. And I would advise you have an argument about why your client incurs that expense to be able to generate income, which in turn allows them to pay their expenses and maybe resolve the tax debt in some fashion. Current taxes. So this goes back to the question we had earlier about current taxes and the importance of that with these negotiations. So your clients, and John had mentioned, they need to be in current compliance, meaning that their tax payments and their withholding or their estimated tax payments need to be sufficient for the current year where they're not going to incur new liability. That being said, if your client hasn't made those adjustments yet, they are permitted the actual taxes that they need to be paying each month to the federal and state to be current. So if your client hasn't adjusted their withholding, they're in the process of doing it, but maybe they need to increase that withholding by 10% to account for federal and state tax obligations, you want to include what they need to be paying to stay currently compliant. And if the IRS pushes back, just have some kind of computational analysis about why that's the correct amount. But the IRS can't force your client in a situation where it's not allowing for enough taxes to be current. And you really shouldn't get pushback on that if you have the analysis to get there.
That said, you also want to really encourage your self-employed taxpayers to get with the program if they're not making their quarterly estimated tax payments, to show good faith effort to try and come into compliance, current compliance.
Absolutely. Other secured debts. So if your clients have the federal-backed student loans, if there's debt secured, maybe a line of credit against their house on top of a mortgage, you can argue the secured debts. Again, I keep on using this concept of being reasonable, they're discretionary, but if your client is paying back a secured debt, and you can prove it's a secured debt, the IRS should allow it. That being said, not to get if your client took out a huge loan against their house to have some kind of unnecessary expense, or the IRS deems unnecessary, you could get pushback there, but that isn't a typical situation you'll see. Delinquent state and local taxes. So this is the idea that your client, if they owe the IRS, they probably also owe the comptroller. So what you want to do there is if your client is in a payment plan with the comptroller, what you want to present to the IRS is proof of the current state tax debt and proof that they're in an active payment plan. And that is something that the IRS should allow. I guess the only caveat there is in certain situations, if the state tax debt is substantially lower than the federal tax debt, there is some authority that the IRS will limit what they'll allow each month for the state tax payments. But again, more times than not, if it's an active state payment plan, you want to present that to the IRS. And with the IRS, what I argue, and what I think is important to argue, if you get pushback on that from automated collections or a revenue officer or an offer in compromise, is that with the comptroller of Maryland, we talked about today, if you don't address your debt, they're going to freeze your vehicle registration. They're going to freeze your driver's license. They're going to pull your professional licenses. And so if you don't work something out with the state, it's pretty clear you're not going to be able to work or generate any revenue, pay your bills, pay anybody, versus, again, working out an agreement with the state prevents all of that. And I think the IRS typically is receptive to those arguments.
I do the same.
Yeah, I've often had some settlement agreements or some negotiation and statement with from a representative that said, okay, we want to pay you first, the controller's office, but we can only do so much in a particular monthly payment. I've often wondered about the interplay between the IRS liabilities and controller's liabilities, and thank you for that. Helps me out later.
And that's really, I mean, conceptually, I mean, I guess the biggest thing when you're going through this whole process, we talk about these standards, we talk about the actual expenses, but everything is discretionary. And so the easy cases are the ones where you can just claim the standards and their expenses line up with the standards, and that gives you an answer. Where things get a little more complicated are the clients who have expenses that either exceed these standards or don't fit into the right pocket. But that goes back to a concept that we mentioned earlier. if the expense is so the either production of income or the ability to avoid a hardship or just conceptually, paying your family or your reasonable living expenses, that's really what the IRS is looking at. And for things like that, I mean, if you just push the issue if you need to and advocate, and if you really need to delve into the manual, you want to explore to see, is there an exception that you can point to specifically? We had a case, for example, not too long ago where a client was living with his fiance. Fiance was unemployed and they lived in the same house. The fiance, her address on, I think we had a bank statement or something, was our client's address. So that doesn't fit in any of these pockets, right? We just talked about for what's a fiance, not a dependent, not a family member, not someone that clearly is in these standards. But if you go to the manual, there was authority about living with a fiance. And so there, if you just dig a little deeper into it, you might see that some of these circumstances are actually accounted for, which makes negotiations much easier when you're arguing with the IRS to have the manual provision in hand.
That your comment made me think of the situation where sometimes with my tax clients, they'll send me documents. They'll try and like print off their like bank information from online or a bill, and it doesn't have, it has like an account number, but it doesn't have like an identifier as to their name or their address, or maybe it has the address but doesn't have their name. And so you may want to give some pushback to the client in that situation, because you need to be able to show that this is indeed your client's expense and that they're paying, not, if there's no identifier on there to show that it's actually theirs, then that's not as helpful.
So, and I think you'll see clients have a tendency to present the records you're asking for in the least convenient way. It'll be, you'll ask for a bank
most
statement.
convenient for them.
Right. So it'll be like a screenshot of a cell phone of something that means nothing to you. And they'll say this proves everything. And
Yeah.
or maybe they'll send you a 30-page document with non-PDF, JPEGs, one per email. That's the nature of the industry, and it's something you'll look forward to. But you definitely want to be able to go back to your client and say, like, you have to be pretty clear. I mean, give me something I can work with here. And more times than not, I think you'll get them past that hurdle, but I would expect that at least one pass through.
Story of my life in appeals. It's like, okay, can you please send me this? And it's like, all right, maybe you could have cropped out your feet in that particular photo of the document. So far it's been relegated to feet, which is a good thing. So, but yes, there's tons of documents in various formats. Some of them more helpful than others. I think the Google storage drive and being able to send it over in an organized fashion has been helpful. And some of the PayPal or Venmo or Cash App statements have been more reliable than some of the handwritten notebooks. But yeah, and I'm still, after 6 months, trying to get a PDF document from a partner in a national accounting firm rather than a JPEG on his counter on a Saturday. So anyway,
Oh my.
it's runs the gamut.
So
I feel like, oh, go ahead, Dan.
No, this one. I mean, we talked about the only thing I would mention with the extension to pay, and this probably won't really be too relevant for the pro bono cases. The IRS, they do have a policy. I think they give you one like 180-day full pay extension. So if you have a client who owes a little tax and the IRS is putting the pressure on them, and maybe they're going to come into some money in the next 3 months to just want to deal with the whole thing, you can call automated collections and request that full pay collection hold. And again, if they haven't requested it before, or sometimes even if they have, you might get it. The thing there, and this happens sometimes too when we don't ask for it. If the IRS says, okay, thank you for your agreement to pay your balance in full, and it's called 180 days, that's basically a hold and collection action for that time. In 180 days, if your client, it occurred to them maybe 175 days in, they actually can't pay it back. Maybe things didn't work out, maybe they did, it doesn't matter. For whatever reason, they can't do it. you can always go back to the IRS and re-engage. I mean, I've never seen the IRS cause a problem. I mean, as long as you're being honest about the situation, and you don't want to, obviously, you don't want to mislead the IRS by asking for a full pay collection hold with no intention to full pay. But my explanation is always, my client believes they'll be able to pay. Obviously, if circumstances change, we'll address it. But you get one of those. So, and again, if your client has a history before you got involved, they might have already burned that, or they might be running out of time with the collection statute. But that's really the argument you'd make for a full pay collection hold. Yeah, and like I said, you just request it, and you should get one. So we have IRS installment agreements. So this is a payment plan, and there's two flavors of installment agreements. We're going to talk very generally right now. So you have just a regular installment agreement is a full payment installment agreement, meaning whatever amount the IRS agrees to per month for your client to pay, by the end of this, or prior to the end of the statute of limitations to collect the debt, your client will pay the balance in full. And so if your client can do it and they have time and they're able to full pay, that's an option. And these, again, they can go through the length of the statute of limitations. During the payment plan, and clients, this is something they need to know, penalty and interest will accrue. So even if the IRS has agreed to it and it's a full pay, there's going to be accruals during the life of the agreement. Penalties, we'll get to this later, those will max out. And so those will stop eventually. Interest, it's going to exist forever until the debt's paid. And there's very limited legal bases to dispute that. So, okay, collection's not extended. So with the installment agreement, I'd mentioned earlier, when you request an installment agreement, the time between the request and a decision, that does extend a 10-year statute of limitations. But if the IRS agrees to the installment agreement, once it begins, that 10-year statute of limitations is going back to a countdown. Regarding the liens, so the IRS could file a lien even if you have a payment plan. You could try to argue against it if the IRS is insistent on filing the lien. Those are tough arguments. If you have special circumstances, your client has some kind of professional licensure that's going to be revoked if a lien is filed, that could prevent it. If your client has nothing to attach for the lien, you could argue that, but the flip side is going to be the IRS is going to want to know, and why does it matter? But you will see this sometimes. I mean, with liens, and this is just in general, nobody wants a lien to be filed. And what I tell my clients is, we can argue against it, but I mean, that's really the trade-off for asking for some kind of long-term agreement or some kind of IRS concession. They need to preserve their rights. And so again, fighting it, there's limited legal recourse that we can pursue, but sometimes that's just, I don't say inevitable, but it's going to end up happening if you can't pay the debt in full. User fees. So with user fees, the low-income taxpayers, there is a reduction, and it just comes out of the payments. So it's not like the IRS is requiring additional payment on top of the installment agreement, but when they get their notice saying your installment agreement's been approved, it'll indicate, I don't know, maybe $84 or something like that along those lines for, just to have the IRS set up the agreement. Regarding types of installment agreements, so depending on how quickly the debt can be paid, it could fit in different pools. So basically, if the debt's going to be paid, I think in under 24 months or a year, and the statute of limitations allows for it, you should be able just to make the request. You don't have to go through financials. You don't have to go through disclosures. You don't have to fight with anybody. The IRS should just allow that. The partial pay installment agreement, which is probably something that you'll be dealing with most commonly, is where the IRS agrees to a monthly payment amount based on those income and expenses we talked about earlier. But based on that monthly payment, the debt won't be paid in full before the statute of limitations expires. And so typically, if the IRS agrees to the partial payment installment agreement, there'll be a carve out or a provision in there that after 2 years or 2 to 3 years, the IRS is going to reevaluate the terms, meaning that your client could be fully compliant with the partial payment installment agreement, not accrue any new liabilities, pay their taxes on time, file on time, and still in 2 years or 3 years, they could get a notice that the payment plan is going to be reevaluated. And at that time, if the circumstances haven't changed, you update the financials and you go through the process again. And you should be able to get it reinstated if things haven't improved. Now, if your client wins the lottery during the first partial payment installment agreement term, the IRS is probably going to want a larger payment. Or if your client's circumstances improve significantly, you're probably not going to get the benefit of the prior terms. So any kind of long-term arrangement that the IRS could reevaluate, you want to let them know. I mean, if things get worse for you, obviously that's bad in some sense, but better for negotiations. The flip side being if things improve vastly for you, the IRS is going to want to cut of that at some point down the road. So the 6-year rule and the 1-year rule, to me, those they generally go hand in hand. So 6-year rule is if you can pay the debt off in 6 years, the IRS should allow it. Basically, you still do the financial disclosures, but the actual expenses, the IRS will defer to the actual expenses a little more so than they would. With those the standards are a little more fluid as long as it pays the debt off in 6 years, if that's within the statute of limitations. The 1-year rule is for taxpayers who have certain expenses that they can change, but they can't change overnight. For example, we'd mentioned, you have a car payment that's too high, or you're paying off a debt that's going to be paid in full for a year. You can argue under the 1-year rule that, for the first year, your payments should reflect actual expenses, but then the subsequent years, there'll be an increase in payments to the IRS based on either resolving issues, like for example, debts that are going to be paid in full that you can then apply toward the back taxes, or maybe your mortgage, you're going to try to refinance to get a lower rate, which is within the standards, but you need a year to do it. And there's authority that the IRS will give you a year to make those adjustments, as long as you're committing to an increased amount in subsequent years. So these are little tools you want to have in your mind when you're determining, what kind of payment plan, if that's the solution, you want to pursue with the IRS.
So we have some secondary slides here. I'm just going to skim over them. This slide is for user fees, sort of the technicalities of when and how your client will pay an installment agreement. It also mentions that there is a form 13844 application for reduced user fee. Typically, if a client qualifies for help through an LITC, it'd be good to check if they also qualify through this for a reduced fee. Some of the details about how to request an installment agreement. You can do it online or over the phone or by mail with Form 9465. Jay, do you want to say just a quick word about the Maryland process?
Absolutely. They were started to move more online with setting up payment plans. Trying to reduce the call volume that comes in to manually request a payment plan. Payment plans are now available through our personal income tax collection section in our group. And I've included a link into our new website here, but we've significantly overhauled our website as of recent. In the past 30 days, it's been a long-term project, and we really want to focus, get taxpayers funneled into our website, being able to set these payment plans up, payments to release an MVA hold, be able to make payments online rather than having to call in or mail checks, which is a very time-consuming process. If you're unable to get through our collection phone numbers, our collection line, I advise the client or view it yourself to be able to see if you can set the payment plan up line using some very simple information there. So bit of major overhaul, and we switched the URL from marylandtaxes.gov to marylandcomptroller.gov. So if you haven't checked out our website recently, I would go ahead and do so. There's a lot of cool new features on there.
Great. So these next slides are on currently not collectible status, and I can start us off. So the IRS policy is that they will not pursue collection if taxpayer does not have the means to pay necessary living expenses, and the policy implementation of that is currently not collectible status. So this is a status granted to the taxpayer if they have no available income or assets, or more commonly, they have limited assets, but the levy would create meaningful hardship for them. Hardship is based on the financial analysis we've just been talking about, using necessary living expense allowances. This status stops the collections process so long as they have it, so long as they have, so that they remain in economic hardship. Importantly, the statute of limitations continues to run while the account is in currently not collectible status. So we've had clients, this obviously doesn't work for every client because some of them really want to improve their finances. But we have clients sometimes at MVLS who are retired and they know they're going to be living on Social Security and their savings for the rest of their life. And if they get currently not collectible status and their status doesn't improve, that it can potentially be, a solution to not having to pay the tax amount. More commonly, we would use this as a way to prevent levies and garnishments, while we also look for a more long-term solution, such as an offer in compromise, which we haven't quite gotten to. And then I think one final important bullet point is that the refund offset would continue unless you get a refund bypass through TAS, which I think we have a slide on that later. But just because you get currently not collectible status, if they get a refund in a later year, that is still going to be applied to their tax debt, even if they have this.
I also, where possible, try to get my client into CNC status, even if we're going to file an offer and compromise, just to kind of, get some relief for them on the front end, but also because then you've already established with the IRS that they don't have the current need, they don't have, based on their income and expenses, the ability to pay, right?
Exactly.
And I would also, just in case there isn't a slide on the bypass of the refund offset, it's critical that you communicate to your clients that if they expect a refund, they need to contact the taxpayer advocate before they file the return, and they need to be able to show the hardship and why they need to get their refund. And that's something that the taxpayer advocate has to do, that we can't do that for them.
Yes.
Yeah, so in the kind of the process wise, as far as getting the CNC status in place, we've talked about the financial statement. You want to get that 433 and the substantiation, put that together in a nice little package, have your information available. You do not need a financial statement if your client is on Social Security benefits only, welfare, unemployment, as their sole source of income. If they have, in the case of terminal illness, there's the IRM section that relates to that. But generally, in most cases, you're going to need to get a financial statement put together, have that ready. You can request CNC status oftentimes over the phone, talking to the ACS line. They're going to ask you, it's going to be a long conversation because they're going to go through the financial statement, basically the 433, and ask you for information. And then, you report that to them, which is why having that spreadsheet is helpful, because you have it at your fingertips instead of leafing through the 433, and you can have your notes there handy. And then sometimes they're going to ask for a substantiation if there's something unusual or an expense that's particularly high or something like that. And they'll give you a deadline by which you can fax that over. Yes, fax. Although sometimes, well, I mean, really, I don't think, Dan, maybe you've had experience. I feel like with revenue officers and appeals officers are using that, the IRS Connect kind of secure messaging, but I don't know that you can do that dealing with the ACS like group of people.
Yeah,
right.
that's what I've experienced. Yeah, so appeals officers are pretty open to it. Revenue officers are hit or miss, but automated collections, it's just still faxing.
Yeah. But then usually, unless they require that you have information faxed in, they can make that determination right there on the phone. They'll put you on hold, they'll crunch their numbers, they'll say, yeah, we think it's, subject to approval of my supervisor, but it looks like, we can confirm that CNC status, or no, it's not. The one thing I would caution is sometimes, I mean, it's been a while, but I have had sometimes where you've had a a situation where you've provided the information over the phone and they've requested substantiation, they give you a deadline, you then follow up with that. So I'll call back, right? And you can fax it to the ACS agent while you're on the line there with them, and they'll review it, and then they'll have a whole new set of questions and want and demand document requests. So keep that in mind so that maybe you have all your substantiation, everything like ready in case you can, so you can just fax it over right there instead of having it delayed further. And then I would always send a letter to your client as a follow-up, just kind of explaining what that means, the currently not collectible, what CNC status means, the fact that they're going to get a letter on an annual basis from the IRS or a notice on an annual basis, reminding them of what their balance due is for each tax year and asking, in a more gentle fashion for a payment. Just so they don't completely freak out about that. But then also the fact that if their financial situation changes and improves, that the IRS may request an update of the financial statements and a kind of a recertification of that CNC status.
Absolutely. So we're coming up on our last hour. We still have about 40 slides to go through. But I do want to make sure we have at least time to talk about the Maryland Hardship Status Program, offering compromise, and then also probably payment and penalty relief, I mean. So why don't we meet back at like 12:06 and then get started on the last sections?
Sounds good.
Okay.
All right, everyone. I think we're back. Um, Checking in on the Q&A section. It looks like the first question is actually about this next section that Jay is going to speak about, the Maryland Hardship Status Program. So he will go over how to, get the relief in terms of the licenses and professional licenses. And I'm reading the other question now.
Give me there we go. Bit of a time delay. Yeah, absolutely. Would like to talk about the Maryland collection alternatives. I always always provide a little statement that I've never worked in the individual tax collections unit, nor have I been in charge of it. So I always provide information from that section for the group. And a lot of the information that I provide to you during these presentations is not available on our website, although it has not gone unnoticed that it's not on the website, and that I think there will be an effort to place some of the information there soon this year. Okay, so it's one person has noted a lot of these have the term hardship in the name. And so it's a little bit confusing to going in between the different programs that are available. There is a hardship status for collection actions. And what you have to do is obtain a Form 433A and substantiation from the client. And you send that to the Controller's Personal Income Tax Collections along with a cover letter. And what this provides you is that the Controller's Office will not take collection actions for a set time period. And certainly, I think it generally a few weeks, a few months, and must be approved by the management of the tax collections group. The Form 433A, I believe there was an earlier question about that. It is available online. I actually have it posted up under our Often Compromise webpage. The 433A that's can be used for or that's required by our OIC program application is the same one that you would use for your collection action. So it's not a different document. It's one and the same. It's a one-size-fits-all document for it. So this essentially is hi, I need some time to figure things out or put together something more substantial or organized payment. Can you please give me some time for hold off on collection action? And typically sent by email to our collection group here. All right, so we'll go on to the next slide. Let's see what we've got here.
HA.
Yes.
Quick question on the last slide. How quickly
Okay,
is
quick question on
the
the slide. If you're
current-
considered to have a hardship with Maryland taxes due, will Maryland be persuaded not to cancel car licenses and professional licenses that are needed to pay necessary living expenses? How can the taxpayer do this, and who do they contact and when? Okay, if you have a hardship with Maryland taxes due, Maryland may be persuaded over the phone, but more likely than not, the answer would be no. The taxpayer can contact, and I believe I have a slide coming up soon about our low income hardship program, where if you meet certain criteria, and generally that criteria is being income below the poverty line, that there's an email address to be able to send those documents in to release MBA holds or professional holds. And there's been a concern about concern that we've hold on to MBA licenses for people that are low income taxpayer and offering some relief from that. And so we do have a program, low income hardship program, not available online, but only available as part of these presentations that I do for the MVLS and other clinics. Should have something on the next slide here.
Have all of the comptroller collections group representatives been well educated on all these programs?
No,
Okay. That was my experience recently.
I'm glad my answer matches your experience. Yes, I can, I have, and I say that, not because, again, I'm the manager of the income tax collections or the director of the compliance, division, but because of feedback, exactly like that. Hey, Jay, I've called in, or I've, emailed our collections section about the low-income hardship program, that you mentioned in, presentation. And the person on the phone said, I don't know what you're talking about. It doesn't exist. So, I think that there should be a push to have it on the website. But again, the reason why I do these presentations is to provide this information to the groups that tend to represent low-income taxpayers. All right, let's see what's on the next slide.
Hey, John, could you
Yeah. Get there.
Sorry,
Here
my
we go.
bad.
No problem. It was a bit of a dramatic pause, and here we are with the information that we have. So low-income taxpayer hardship programs, you can call. I think there's been some feedback that it's difficult to get through, and you can review a request for low-income hardship program, or you can email collections at here's the email address low-income program at marylandtaxes.gov and request a review for a low-income hardship program. So that would get you the MBA hold and professional license hold released. You should remember to include the power of attorney and have a power of attorney on file before calling collections. Main benefit is the release of the MBA hold. The historic reason for the program has been that the driver's license holds and professional holds have disproportionately impacted low-income taxpayers and perhaps some demographics as well. But that's the reason for the creation of this program. Here's the information that you're going to find on the slides, and we'll be able to find on our website.
Hey, Jay,
Yes.
another question. What's the current lead time on getting those requests processed? If you email it in or call it in?
I don't know. And that's an honest answer.
Okay.
Older I've gotten, the better it is just to say I don't know. I don't think that's a statistic that we currently keep track of. Would be neat to need one. And let's see what we've got on the next slide. I think I put together a few collection slides here. Okay, and so there's three types of hardship programs, and I'm going to go over those quickly. Hardship cases where someone's below the poverty line, receive Social Security benefits or a pension. A low-income taxpayer program where I believe they're below the poverty line and receive wages. And then there's also an income exceeds expenses program for this MBA hold. The common benefits, no payment or payment plan required, release of the license. It's a restriction on future license holds. You're not referred to a collection agency, and there's little to no documentation required. And according to our group, fast approval. So, sure, agree what timeline we're looking for. I think the general headline is fast approval. I believe would typically take 90 days for to review and make a decision on an OIC now. Here's some background about what those hardship income exceeds expenses means. We'll go through that. I just did. All right, let's go on to the next slide. Okay, let's see what we got next. Okay, I mean, for these hardship programs, the liability still exists. If there's a notice of tax lien that's been filed, interest will still accrue. It's not a resolution globally of the problem. It's just in order to be able to release those MBA and professional holds, and that's what it's for. Okay, let's see what we go next slide. Okay, here we go. Oh, I see. I always love this topic.
All right, so this is, I'll try to do this, I guess we'll try to get through this quickly because we have a lot of material to cover, but this is important. So this is the offer and compromise. It's the offer and compromise. the IRS and Comptroller both have a program where you can try to have your client's debt settled for less than the full liability. And so under the IRS, it's governed by the Internal Revenue Code 7122. Gives the IRS the ability to settle debts. And I mean, the bottom line is under the manual, I mean, the objectives, it's supposed to be in the best interest of the taxpayer and the government, and give the taxpayer a fresh start. And for certain debts, the government's never going to be able to collect. Just let them write off, the portion that can't be collected and close out the account. So there's three general types of IRS offers and compromise. So the most common is the doubt as to collectability. And so there, it's basically if you can prove that your client can't pay the tax debt in full in the period the IRS has to collect the debt, the IRS should be open to a settlement. And it's the same types of financials we've talked about earlier. The biggest difference that I've experienced with the offer and compromise for collectability than with the other collection alternatives, especially when you're dealing with automated collections, is that automated collections for a payment plan or hardship status, there's not, you can usually get past equity and assets and still work out an alternative, a collection alternative without having to, liquidate if there's a small retirement account or investment account. The IRS typically is pretty agreeable to some kind of option there. For an offer and compromise, if there's an asset, the IRS is going to include it in the financial analysis. And so this can be a real problem with taxpayers who, if they own a home and there's $20,000 or $10,000 of equity in the home, so practically that's not something a taxpayer is going to be able to tap into. They're not going to have the means to borrow against it. They probably get denied. If they did, they probably wouldn't be able to pay that loan back. And it's not feasible to have somebody sell their house to get $20,000 to pay the back taxes. So in that case, the offer unit, though, could fold in $20,000 into what should be included in a settlement. And it's possible through advocacy, you could get that overturned and legal arguments that you can raise, but that's going to be a hurdle you're going to see in the offer collectability program. That might not be as big of an issue as in the other collection alternatives, which, I mean, we'll go through that, but other types of offers, you have doubt as to liability. So if the taxpayer, your client, has a debt that you're disputing for some legal ground, it could be an invalid assessment. You can actually use this to dispute penalties and interest too if the law warrants it. But that would be, so you're not disputing the ability to pay, you're disputing the underlying assessment. And so there, that you'd raise your argument about whether or not you had a valid debt or penalties and interest. Effective tax administration. So this is basically, you're arguing that your client could pay the debt in full, but for some reason they shouldn't have to due to exceptional circumstances. And there's a couple of ways to, so one would be, you could talk hardship, where if they liquidate everything they have, yes, it'll pay the debt, but it's going to leave them destitute. That argument could work. I mean, it's going to be tricky because the IRS, the offer unit, is probably going to push you toward other collection alternatives. For me, I mean, if I'm arguing effective tax administration, which normally it wouldn't be my only argument, but I would fold it in. But recently, I've used it in cases where you have people who are victims of romance scams or lottery scams where, and this is it's becoming more common, which is a little alarming. It's very alarming, but for taxpayers that basically become the victims of these scams, the scammers typically convince them to liquidate their retirement accounts. And it could be, again, for romance scam. It could be because they need to send money somewhere to make more money or win some kind of prize lottery. And typically the scammers are targeting pretty vulnerable taxpayers. But either way, if your client was involved in the scam and liquidated, they had 100,000 or 50,000 in retirement, they could have the whole retirement could have been liquidated and sent over to the scammers. Your client's on the hook for the tax consequences of liquidating their retirement account. And so we've argued effective tax administration in cases like that. I mean, most recently, the IRS, they pushed back on it, which was a little disconcerting, but it did give us more leeway in settlement. So those are situations where, I mean, I think the most straightforward arguments are doubt as to collectability, but you can also, again, you can fold in multiple offs. You can do doubt as to collectability and effective tax administration. And I believe that the IRM requires the offer unit to consider all potential offers when one submitted, given the circumstances. So that's the broad umbrella of the offer program. Okay, so this is something that I think we mentioned before. I think John might have mentioned it. If the IRS accepts an offer in compromise, you just need to let your client know that the IRS requires 5 years of full compliance, or until the offer is paid, whichever is later. Typically, it's going to be the 5 years of full compliance. So, for example, if your client gets an offer accepted and it's accepted tomorrow, the balance, they pay whatever amount is due, the balance gets written off, but the case stands or remains in what's called the offer monitoring unit. And so that monitoring unit for the next 5 years is just going to make sure returns are filed and any balances aren't accruing. And so what you don't want is 4 years into an accepted offer and compromise, or after an accepted offer and compromise, for your client to get a $30 penalty. That might have been even paid in full, but a letter goes out to your client 4 years after the fact saying, we're going to terminate your offer and compromise because of this small issue. And those are types of things that recently, what I've seen the last few years, if something like that comes up and you're proactive and contact the monitoring unit, they've been pretty flexible. So you don't want to be there, but I've been able to maintain the offers by curing the issue. But the flip side is if your client's moved and lost contact and the IRS sends a letter to your client and they ignore it can be a pretty small, innocuous problem that terminates an offer and compromise. And if that does happen, the full debt's reinstated with any kind of penalties and interest that would have accrued over the last several years. So you just want to let your client know to be aware of that, because that is something that can be a real problem, obviously. Okay, so the offer and compromise, one of the considerations on the front end when you make that decision, so filing the offer and compromise stops the collection statute of limitations. So your client could have a slam dunk offer case, meaning, I mean, that you could confidently prove that the IRS knows they could collect, let's say it's $5,000 or $1,000 on a $50,000 debt. That being said, if the statute of limitations has 3 months or 6 months or even a year, and the whole balance expires, it might be in your client's best interest to pursue other collection alternatives that don't toll that statute. Because what you don't want is for the offer and compromise to be filed and find out a year and a half later something occurred where the IRS either wanted a higher payment than you were offering, or circumstances change and your client might be able to pay more. And now you've got an active collection statute that would have been expired with another option. So an offer and compromise, if once it's filed, the IRS can either accept it, reject it, or return it. If it's accepted, you're fine. The case is closed. I mean, there's small carve-outs and very unique carve-outs for times that can be reevaluated, but that's only if there's a mutual mistake of material fact, which it's uncommon. More likely than not, acceptance is going to be accepted. Rejection, not ideal, but at least a rejection means that the IRS, it was a processable offer. You met the terms of the offer as far as not accepted, but whatever requires to submit an offer, but the IRS then rejected it, arguing probably that it's either a full pay or you can pay more. That can be appealed. If you file an offer and compromise and the IRS determines that your offer cannot proceed for a compliance issue, for example, let's say that you filed an offer and then the next year while your offer was pending, you accrued a new liability where you're not paying sufficient taxes throughout the year, the IRS can return an offer. And so if the offer is returned with the argument that you're not eligible for an offer for typically a compliance issue, that's the worst position to be in, because at that point, you've lost anything you've paid in, if anything, and you can request a reconsideration of the return. And that's the extent of your legal recourse. There's no appeal. There's no more argument. You can submit a letter. You can try to talk to somebody. And that can be reevaluated, but that could also be the end of the line for that offer, where your only option, if the offer compromise was what you wanted to pursue, we file another offer compromise. So those are all things that you just want to be aware of, in the early stages of the offer, and just make sure your client knows that compliance for the offer and compromise, that there's a 5-year period after acceptance, but the day that offer is filed, you want to be able to prove current compliance, because the IRS, the first thing they pick up an offer, which could be 3 or 4 months after it's filed, is to see if your client is currently compliant with their taxes. And so once the offer is accepted, if it's accepted, while it's pending and while it's under review, your refunds are going to be offset to your liability. And this changed a few years ago. The date of acceptance, if accepted, any refunds at that point should be released to your client after the date of acceptance. When previously it was that calendar year, the IRS would hold on to your refund even if accepted.
So I can dive in here,
Cool.
Dan. The process of filing and preparing the offer and compromise package is time consuming. So it's a lot of what we had discussed before, but it's, whereas with currently not collectible status or an installment agreement, the IRS isn't looking, they're looking more at your income and expenses. As we've discussed already, they're looking, at the whole picture. So your assets and liabilities as well. And so there's a more comprehensive set of forms that need to be completed. And this slide, it lists the different forms. So if you go to, you can see there's a link up there. And with any IRS forms, I would always suggest going online, even if you've just used it not so long ago, and make sure that you have the most recent form, because they do periodically update them. And so this is an example. They just updated so the 656 E is the booklet for the offer and compromise, and it has the 433A, 433B, and the form 656. And so they just updated that last month. So you always want to make sure you have the most recent form so you don't risk having them rejecting anything. And also because you want to make sure that you review the terms that are, so that booklet spells out all the various terms that are involved, the list of documents that Dan had mentioned before, the terms like with regards to the future refunds that Dan had just talked about. That's all in that booklet. So this is a little bit in kind of reverse order, but the offer and compromise, the 656 is actually the offer itself. And that kind of comes after you fill out the 433A and or the 433B OAC. So you have the 433, then the 656, which kind of spells out, this is kind of, so the 430, let me just back up. The 433 for the offer and compromise goes through the income and expenses, your assets, tied in there is some liabilities, whatever isn't covered, I highly suggest you include that in some other fashion, in an affidavit, your cover letter, and in some regard. I also provide an affidavit that's signed by my client that kind of provides some more detail. So we don't just have a form with numbers and documents to substantiate the bills and stuff, but we also have an affidavit that kind of explains, why we have this higher car payment or child, care expense or whatever it might be. So it kind of humanizes things a little bit. So, and then at the end of all the financials, there's a formula that the IRS has that basically says, I think the next slides kind of go into that some, but it kind of, they have their calculation for what they think should be the offer amount. And so you take that, and then based on that information, then you would complete the 656, which is the actual offer. They ask how much you're putting down, what type of offer it's going to be, which is covered in some of the next slides. Where's the source of your money, stuff like that. And then there is an application fee. And so you'll want to read through the guidelines that are in the offer itself, because depending on if you have a single taxpayer or a couple, and whether there's separate or joint liabilities, that would impact basically the nature of how many offers you have to submit, and and whether it's just an individual or the individual has a business, and the fees that are involved. Okay, with the MVLS clients, if they meet the low income certification guidelines, and there's information in there about that, then they don't have to pay that processing fee. They also don't have to put down, so there's two types of offers, there's, if you look at number 2 here, it says 20% lump sum or the periodic payment. So you, depending on which one you choose, so through the IRS calculations, they figure out what your net income is on a monthly basis, and then what your net equity and assets is. And in doing so, they'll look at like, what's your mortgage, or what's the fair market value of your house or your car, less whatever loan you have. And then they discount it. So they take 80% of that value for your net equity and that asset. And there's certain things that they give allowances for with regard to like bank accounts. That kind of net equity and all of your assets and the net income they use then in this formula. And so the 20%, basically, if you're going to go that route, you would take that number and times it by 12, and that's the number that they think your offer should be. So then you would have to basically put 20% down unless you're a low income person. And then the follow-up payment would be, only if, or payments, depending on how it's structured, would only be if the IRS actually accepts your offer. If you don't feel like, or your taxpayer doesn't feel like they have the money to put down for that 20% lump sum, the other option is to do this periodic payments, which they take that kind of net number of the net equity and in your assets plus your net income, and they times it by 24, and you would have to start basically making, that's your offer amount, and you would have to start making periodic, like monthly payments from the time that you submit your offer through to whenever that is done. So the thing to note with low income or exceptional circumstances is that even though the formula says that it should be, X amount, you can definitely argue that it should be a lower amount. Obviously depends on your client's circumstances, but I would say in most cases, when I file an offer, I don't just go with the number that the IRS formula spits out. I go on what I think my client can actually, and as through consultation with my client feels comfortable paying, and will present as robust an argument as possible, expecting that we'll get some pushback from the IRS. But and so there's all this, these are the different items that you need to really kind of put together in your package and submit to the IRS. You want to make sure you include your 2848. Again, like, your combination of your cover letter and maybe an affidavit from your client, kind of providing additional information to look, tell the IRS, like, why is it that they have, if they have a reasonable, set of facts as to why they came into this situation, that they have this liability and why they can't, pay it. And obviously any, law that is relevant and whatnot, and the substantiation. So, typically this is all hard copy, sent in, certified return receipt. I haven't done it, but it's my understanding that there's a way that taxpayers can actually submit an offer request online through the IRS's portal at this point, but I haven't done that, so I don't know the mechanics of it. And yeah, so this goes into a little bit more as to the mechanics of the formula, so to speak. It's based on the reasonable collection potential, the future income. So if they're going to pay the offer and within less than 5 months, they consider the 1 year of income, whereas if it's going to be longer, that's 2 years worth of income. And then I'm just looking at the comments here. Oh, yeah. So like they'll allow, college student loans. They're not going to allow, not that this is going to be an MVLS kind of client, but if you have somebody who's paying for private school for their high school for their child, that they're not going to they're not going to consider private high school as a necessary expense, but college is a guaranteed student loan, because it's already in place, they'll accept that. I think we talked about the state and local taxes before. Dissipated assets, you don't want to have a situation where there's evidence that the taxpayer has tried to basically get rid of assets in an effort to avoid their tax liability. And if there's income producing assets, generally that equity in those income producing assets will not be included because they need those assets to basically produce the income.
So I did see in the Q&A there is a question about what counts as, oh, I think Tim might be typing, but what counts as definition of low income? I guess it might vary a little bit depending on how they're asking, but for the LITC, it's generally 250% of the federal poverty level, and that based on the number of people in your household, and that number gets updated each year. And when you actually go to like fill out the waiver for in the OIC context, it'll give you that information.
Yeah, so the offer and compromise, the form, I was going to type it out, but the form 656, which is the offer and compromise form, there's a low income certification that details specifically whether or not your client is going to qualify for low income. And it goes through specifically, just like John was saying, household size, where the client is located, and what the maximum household income is. And so you're required to confirm whether or not your client is eligible for low income certification as detailed on the 656 form.
And we will be providing these slides after the presentation, so you don't need to write down everything. So just quickly going over payment terms, there are generally two types of categories of payments for an OIC. There's the lump sum and the periodic payment. With a lump sum, it's not a completely lump sum. It might be a little bit of a misleading name. You pay 20% of the total offer with the offer, and then you pay the remaining with 5 or fewer payments within 5 or fewer months of the date of acceptance. So maybe not all at once, but it is paid in a relatively short time frame. Periodic payment offer is generally preferred by clients if it's a larger amount. You make the first payment with the offer, and then it sort of works out like an installment agreement. You pay the remaining balance in monthly payments within 6 to 24 months in accordance with the offer term. But no matter which one you choose, they won't consider an offer if you don't pay it off within 24 months of the date of acceptance, so 2 years. That's as far as you can go.
Yeah, it's like that Sherry mentioned, she talked about. So the offer and compromise, I mean, for the IRS and Maryland, I mean, there's a large part of it that's computational, which is what we've been talking about. You go through the numbers, and you present your argument that your client can't pay the balance that's owed, and so a lesser amount should be accepted. But I mean, whoever it is who's going to be reviewing it, just a person, and they're going to have preconceived notions, and they're going to have discretion to make decisions. So if you have the same set of taxpayers with the same financial situation, and one of them, just I don't know, decide to buy luxury vehicles and then lost his job or her job and then couldn't pay the taxes back, that's one story. Or if you have somebody else with the same tax debt who was laid off and has a medical issue and is raising kids and is a decent person and it doesn't have a future potential to pay, I think that's where the narrative, it could tip the scale one way or another. I mean, if you have very unique circumstances or something you need to bring to the IRS's attention, that's going to have much more of an impact. But for somebody who just can't pay the debt back, I think that, again, if you have a examiner who's on the fence, the narrative could be the determinative factor.
I know sometimes the narrative is also helpful. Like, I know even when I first get those bank statements and I'm going through and I'm looking at things like, this is interesting. And like, I can imagine the IRS or a comptroller employee going through that and going, why should I give this person, a break? This doesn't look like, it just doesn't, it looks frivolous or, whatever. And so if you can explain why that exists, whatever that expense is or the situation, that's helpful.
Okay, I'll go from here. Maryland also has an offer and compromise program, and I took over the program in hearings and appeals with the change in the administration as of let's say we've been January of 2023, and I have tried to move the program to be more like the IRS. It's similar. We don't have a statutory authority that says the controller's office can do an offer and compromise program. We've got some statutes which I may have put highlighted on in this slideshow that offers us to settle a claim against the state within 2 years. But I've taken over the program. I've switched it from an all paper submission process to an electronic submission process. I'd say the majority of our offer and compromise applications are done electronically. And if there was also a second headline there, that I've moved it away from a group of people, I think, looking at various factors, such as there was on the previous slide, to income versus expenses. I think that everyone on this panel has had some experience with our offer and compromise program and applications. And it's typically in the past, I think it's been said, not really sure what to offer or how the process works. But I've attempted to move my program away from relying on a variety of factors and a different group of people that review things that are subjective to the objective, income versus expenses. And I've also strived to get the decisions out within 90 days by reorganizing and dedicating people to the review. Not every decision has been made in 90 days. Had some a few things that slipped through the cracks or may have a little bit more difficult facts. But ours is moving toward the IRS. And John, if you can move to the next slide. Let's see. We've got all of our information online. There's a great FAQs that answer some of our questions about a look back period. We've modeled that on current plus 6 years previously, and our eligibility requirements. A lot of great information online. I guess next slide, John. And I've provided these. One of the biggest differences between the IRS and the controller's program is the 2-year requirement. You have to be in arrears for the debt for 2 years. And that's kind of an interesting standard. Is it from the date of assessment, the tax computation notice, the date that something was filed, and or the date that it should have been due, but you didn't file an income tax return. We are moving, and we've put together policies and procedures internally for this. And we're moving away from the date of assessment to when the return should have or was filed, or that there was a notice to the controller's office that something was due. So that's one of the big hurdles, is getting all the returns filed and having a 2-year wait period from that. I guess, John, the next slide. And so I've listed the requirements which are available on our website. Again, we're looking for I guess, either a non-contested decision. It's not in bankruptcy and has been in arrears for 2 years, and the taxpayer just does not have the ability to pay the liability. All right, we'll move to the next slide. Let's see. Okay, again, primary consideration, and I've put this in our policy and procedure, income versus expenses analysis. Secondary, accuracy of financial disclosure statement and supporting documents. We do not have a dedicated team to review all of the documents that are sent in with us, like the IRS. We do have a team that will process those OICs. But if the financial disclosure statement look accurate and look like they've been, that time has been spent to work on them, and nothing jumps out either as false or a rush through. Sometimes I see some applications and they just write NA, 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 crossed it, and looks like it took about 3 minutes to do it. What consideration to give that? But other considerations, whether outside of it, as on a different slide, Those are a tertiary consideration. Okay. All right, so let's see. So yep, we'll notify in writing. We do offer counter offers. Do send out decline notices. Most of those have been for the 2-year requirements or the fact that the returns have not been filed for the current plus prior 6 years. They are final and non-appealable, and you have to stay in compliance with future filings for 3 years. Let's see what we've got next. All right, there we are.
All right, so the IRS, there's a couple of typical penalties you'll see with unfiled or unfiled returns or unpaid balances. So the first is failure to file. So late return, it's due April 15th of the following year of the return. If you file an extension by April 15th, so that's an extension to file till October. So that will prevent the failure to file penalty until October. But then if you file beyond October, we're still looking at 5% per month up to 25% until the return is filed. So basically, if your return is 5 months late, you've maxed out the failure to file penalty. Failure to pay, so there's no extension for failure to pay. So April is when the return is due, April is when your balance is due. If you don't pay, the extension doesn't really have any bearing on that. You're going to start incurring your client is going to incur 0.5% penalty per month up to 25% of the unpaid balance. And while there's both a failure to file and failure to pay penalty, the failure to file penalty offsets the failure to pay, or failure to file, or failure to pay offsets the failure to file. So those months your client's getting hit with a 4.5% failure to file penalty and a 0.5% failure to pay penalty. There's also failure to make estimated tax payments, which that's typically a smaller penalty, and that's just if you don't make adequate, or your client doesn't make adequate payments throughout the year. There's going to be some, usually a $100 penalty or something relatively small that gets assessed when the return is filed. And then, so there's really 2 ways to attack the penalties, and these are specifically the failure to file and failure to pay. One is first-time abatement. So if your client has 3 years of no penalties, so this is only specifically failure to file and failure to pay. So for 3 years, no failure to file or failure to pay, and then that 4th year, there's a failure to file, failure to pay, or both. You can contact the IRS, request first-time abatement, which you don't have to argue any legal hardship, any financial issues. It's just request first-time abatement, and if they meet the criteria of 3 prior years of compliance, the IRS will abate the penalties. And you get that really every 4 years, or your client gets it every 4 years, as long as there's 3 years of compliance prior to the request being made. If your client isn't eligible for first-time abatement, there's reasonable cause, and that can be, I don't think we have time to go through all of it today as we're approaching the end, but the standard is basically where your client, can you prove that a reasonably prudent taxpayer who took precautions to be in compliance would have still filed the return late and or failed to pay the tax on time. And the IRS, the manual, there's case law, it goes in depth about the different scenarios. You look at each year on its own to facts and circumstances of why the return was filed late, why the return was paid late. And you want to put together the best argument you can about why, again, a reasonably prudent taxpayer would have still had the same compliance issues that your client had. And then you submit a claim for penalty abatement, arguing that reasonable cause. My advice is that you want to have documentation lined up about the circumstances. You don't want to be generic or say, well, my client was suffering financial problems during that year. That's probably not going to prevail. My client's accountant told them that April 15th wasn't the filing deadline. That's probably not going to prevail. But if you have something where, my client was going to his accountant, I don't know, to drop off the signed return and I don't know, he got in a massive wreck, or the week of tax were due, his house burned down. Those are the extreme circumstances where that's the kind of stuff that I'd say the lower hanging fruit the IRS is going to be more inclined to grant relief. The hardest cases are really the in-between cases where your client has a good argument about why things were done late or filed or paid late. And then your job as the advocate is to present that argument to the IRS as best you can, backing it up with whatever authority you can and whatever records you can, and fight for that. And you get a claim, an administrative claim. And if that's denied, you can appeal it as well, and you get one level of appeal. So that's something where if your client can and likely will pay the balance in full, it's worth exploring to see if you get some penalty relief.
All right. Thank you, Dan, for blazing through those last penalty relief slides. I really appreciate it. We have some more secondary slides here on penalty abatement for your reference, going through a bit more of what Dan said about reasonable cause. I think we have some pages here on Maryland penalties, but I think we might want to just leave those for people to reference. And yeah, the other collection alternatives, which we won't go into too much detail today because we're running out of time, are amended returns, audit reconsideration, and innocent and injured spouse. I believe most of the amended returns are reference files, are reference slides. And the innocent spouse relief, I think, are mostly reference slides.
Mhm.
Do you want to talk maybe very, very briefly about appeal rights?
Yeah, I mean, so basically, so collection due process, you have two different types of appeal rights. You have collection due process and cap appeal. So collection due process, we talked about those earlier. You get a notice of federal tax lien, notice of intent to levy, and the IRS sends you a notice, and you're given a 30-day window to file the appeal. And that can go through an administrative appeal, can go to tax court, that prevents collection action. And more times than not, if you're going to pursue appeal, that's what you want to appeal. There's a whole other set of appeals and collections called collection appeals process, or cap appeals. And those are very specific situations where if the IRS has levied your client, after the levy's issued, you can file an appeal, or if the IRS has threatened a levy action and you don't have a collection due process appeal, you can do a pre-levy cap appeal, which is a powerful tool if the IRS is threatening you, and that will prevent the collection action. You can installment agreement if that's rejected, if it's terminated. Those are all cap appeals you can file. And so you have a vast amount of situations, and they're all in the Internal Revenue Manual that give you a cap appeal. And cap appeals can be it's a good tool, it's a helpful tool, it can get a job done. But the trade-off is you get one appeal, and one hearing, I should say. So when a collection due process appeal, maybe there's a disagreement there if the IRS did something wrong, you have tax court, you have other remedies. For a collection appeal, for a cap appeal, you could be right. I mean, you could have the perfect argument. If the appeals officer rejects it, you could try to go to supervisor, you can go up the chain of the appeals command, but there's no legal recourse. That's the answer is the answer. And ultimately, you have to accept that and move on. So for me, I mean, it's good, most prevalent with installment agreements where there's a disagreement or the threat to terminate when my client didn't do anything wrong, but maybe it was an IRS issue. And that threat of levy, especially with the revenue officer. So if you have a revenue officer who is threatening you, and maybe there's a deadline that you've asked for an extension, but for whatever reason, your client needs a little more time and the revenue officer says no, you say, I want a pre-levy cap appeal, put it in writing, and then that requires a manager call, that requires a hearing. And hopefully either the IRS agrees to give you more time or work out whatever issue caused the levy or potential levy, or the time you get from at least going through that process, you can cure whatever issue, deadline was missed, for example, or something needed to be done to make the threat of levy a moot point. But that's all something you want to be familiar with when you're working with collections.
Mm-hmm. We also have collection due process, but I think you touched on that as well. And then more general tips about, okay, yeah, we've reached roughly the end. So I think, compared to previous years, I think we did pretty good this time. And I think I just want to close out first by thanking all of our presenters, Dan, Sherry, Jay. You guys are amazing. Thank you for doing this. I believe this is the third time you've agreed to present for us. And I want to say thank you for everybody to attended. If you are interested in taking a case with MVLS, you certainly have quite a good toolbox at your disposal now to do so, at least in our tax program. So I have a screenshot of our from our site here. You can see that you can navigate from there to our pro bono portal. And as I said, when you sign up for MVLS, it's up to you to take cases that interest you, and where you think your time is best served and when you are available. Some more advantages of volunteering with us is, oh wait, this is the case management overview. But essentially this goes through I know it was a lot of information, but this goes through the process typically of volunteering with MVLS. If you're interested, I can go through this whole process with you guys after this presentation. But when you volunteer with us, you also get you get a copy of these slides, which I think I'll just get you guys an email. I can email it to you. We'll help you get the necessary IRS forms and publication sample documents, some helpful documents from Taxpayer Advocate Service, and if you're interested, access to mentors who, depending on availability, maybe Dan or some others. And finally, I just want to say that this really does make a difference. I have some examples of cases here. There is actually one case available right now in Hartford County, a client currently living on Social Security and TDAP. 2019 return was audited. IRS, predictable disallowed her EITC, Schedule C, head of household status. Unfortunately, she did contact us after audit reconsideration was concluded, but we are still looking to help her with this overarching tax bill. So if any of you are interested, that is available on our portal right now. And thank you all for being here.
All right, thank you to all the presenters on behalf of MSATP. Before we conclude, a general reminder to complete the webinar evaluations. Your feedback is crucial in helping us improve and provide you with better experiences in the future. Thank you all for joining us today. We appreciate your time and participation. We hope you have found this session beneficial, and we look forward to having you join us in our future events. Thank you and have a great day.
Thank you.